हाँ, लोग बैठे हैं फटाफट कनेक्ट हो गए।
Arpit, we have 2 minutes more, right?
Yes, sir. We will start at 4:30. Yes.
Yeah. Okay, good evening, everybody, and welcome to the first session on day 2 of the conference. This session is on the banking sector, and there are 3 papers to be presented. The first paper is by Arpit Kumar and Vipul Mathur, Banking Sector Expectations and Financial Stability. The second paper is by Sriniwas, Mahapatro, Nishant Kashyap, and Prasanna Tantri, Indirect Evergreening Using Related Parties, Evidence from India. And the third paper is by Shreya, Biswas, and Rajnish Kumar, Bank Board Network and Financial Stability in Emerging Markets. So each of the speakers will have 20 minutes, and I will warn them 5 minutes before they hit the 20-minute limit. Okay. So welcome once again. We are very happy to have you at the conference. Okay, so without much ado, I think Arpit, you can start.
Okay, sir. So, sir, is my screen visible?
Yes, it is visible.
And just okay. So thank you for considering our paper for the program. This is joint work with my advisor, Vipul Mathur at IIM Calcutta. In this paper, we are looking into how banks form their expectations about the future, which is a key input into how banks assess the credit risk of their loan portfolio. So when a bank makes a loan, it has to form expectations whether how that loan is going to perform in the future. If the borrower is going to default tomorrow, what fraction of the loan I can recover and what fraction I'm going to lose. So we are trying to study whether those expectations are rational or banks are making any systematic mistakes. Now, what motivates this study, we have seen many financial regulations have received a lot of criticism during the last financial crisis and also afterward. Allegedly, they are partly responsible for prolonging the recession that followed the crisis. They made it difficult for banks to supply credit. But to effectively modify those regulations, there is a need to understand the underlying behavioral bias that affect the financial institutions or in particular banks, which is the focus of this paper. For instance, take the case of loan loss provisioning rule. When a bank has some information that a particular loan has turned bad, it forms expectations for fraction of the loan I cannot recover from the borrower. And then the bank immediately recognizes that amount as a loss on its income statement, while the actual loss is going to happen sometime in the future. Now, the rule that banks were following during the crisis and also many years after that is income loss provisioning approach. It's a backward-looking approach where a bank can recognize loss for a loan that has turned bad based on the information available till the reporting date. Say the bank has some information which says in future economic growth is going to decline, and in that bad scenario, this particular borrower is going to default. But you cannot recognize loss for that loan because the loan has not turned bad yet. So what the repercussion of this rule? When recognition of credit loss is delayed, when the actual downturn sets in, the bank has to recognize loss. Now it negatively affects bank's balance sheet. So the bank cannot supply credit. It impairs its ability to supply credit, thereby making the downturn worse than what it could be. So how do you resolve this? If you can allow banks to recognize some more provision during good time, it can act as a buffer against the loss that is going to happen in bad times. Now, this has been suggested by the Basel Committee, and recently it has been adopted by accounting standards, IFRS 9 and also US GAAP. So they are calling it expected loss approach, and this has been implemented recently in US. I mean, we don't know how the rules are going to look like exactly or how effective these rules are, but this is something in principle similar to the dynamic provisioning rule that has been there in Spain since 2000. Now, what we are doing in this paper, how do we contribute to this debate? We are asking what if banks' expectations were not rational? So be it incurred loss provisioning or dynamic provisioning, whenever a bank recognizes a loan has turned bad, it has to form expectations, how much I am going to lose. We are asking whether those expectations are rational or banks are making any systematic mistakes. So what we are going to do in this paper, first we are going to compare banks' expected loss with actual loss that is going to be realized in the future and try to find out whether banks make any mistakes or not. If banks are making any systematic mistakes, what's the next best alternative to rational expectation that can explain banks' behavior? And once we find the next best alternative mechanism, we are going to embed that in a standard macro model with dynamic provisioning rule and study the implications for credit cycle. So to give you a brief preview of our finding, when we analyze banks' expectation, we find banks overreact to current conditions. What do I mean by that? In good times, when banks see a decline in loss on their loan portfolio, their expectations are too optimistic and banks underestimate credit loss for their loan portfolio. And in bad times, banks do the opposite. When banks see an increasing loss on their loan portfolio in the recent past, they are too pessimistic and overestimate credit loss on their loan portfolio. And we show that diagnostic expectation, it's an alternative to rational expectation, is better to explain this bank's behavior. And as a result of this kind of thinking, the bank in good time, it is going to charge a lower lending rate, and that will lead to excess lending, investment and output in good times relative to a rational bank. And in bad times, the bank is going to charge a higher lending rate, which will lead to a decline in credit supply. So there will be decline in investment and output relative to a rational bank. So in a sense, this alternative expectation formation mechanism, it amplifies the fluctuations in economic activity. So what's the key takeaways? So any financial regulations, say this dynamic provisioning rule, which are intended to mitigate this procyclicality, this reinforcing interaction between credit and business cycle, they need to be adjusted for this underlying bias, for the extent of overreaction that is there in banks' expectation. For the interest of time, I will be very brief on the literature. So primarily there are two strands of literature we contribute to. First is this using loan loss provisioning rule for macroprudential purpose. Now there are all these papers, they find dynamic provisioning rule is effective in mitigating procyclicality, but all these papers assume banks have rational expectation. There has been no attempt made to analyze banks' expectation to find out whether this rational expectation assumption is true or not. And the second strand of literature we contribute to is investors' belief or sentiment when they deviate from rational expectation, how that affect credit outcome. Now, much of this research in this literature is concentrated on stock and bond market. We show that this sort of bias overreaction is also prevalent in the banking sector. So for this study, we're going to focus on US banks. We collect banks' income statement and balance sheet data from FRY 9C reports filed by these banks quarterly. In total, we have 49,910 bank quarter observations from 1987 to 2019. So as I said earlier, we are going to compare expected loss, that is loan loss provision, with actual loss, that is which banks record as net charge-off in the future. So before I get into the empirical analysis, we build a simple model to motivate our test for rational expectation hypothesis. Let's say every quarter or every period, the amount of loan that banks lose, call that fraction GT, which follows an AR1 process with normal shock. So call that fraction GT, which is equal to rho GT minus 1 plus 1 minus rho G naught plus some epsilon shock. Z naught, you can think of some average loss over the whole cycle. The bank today observes GT. It has to form expectations about tomorrow's loss GT plus 1. Now, under rational expectation, this GT plus expected value of GT plus 1 would be rho GT plus 1 minus rho G naught. Tomorrow at time t plus 1, actual loss is going to be realized. Now, when you take the difference between actual and expected loss, the forecast error, which we call forecast error, is simply this random epsilon shock. It should not be predictable using any information that the bank has when the forecast is made. For instance, if I run a regression of this forecast error, on current loss, which is the past loan losses, this coefficient beta should turn out to be indifferent from 0. So that's what we are going to do. We are going to construct the forecast error term from data, and using past data, we are trying to find out whether this forecast error is predictable or not. So to construct the forecast error term, we take the difference between actual loss minus expected loss. For actual loss, we take average of net charge of average of actual loss that is realized over the next 4 quarters from quarter T+1 to T+4. For expected loss, we cannot use loan loss provision directly because it has been found in the literature that managers manipulate loan loss provision for earnings management, signaling, and other purpose. So what we do, we decompose this loan loss provision into 2 components, a non-discretionary and discretionary component. So basically, we regress this observed loan loss provision on a set of bank-specific and macro variables that has predictive power for future loan losses. For instance, non-performing loans, past loan losses, GDP growth, unemployment. And we take the fitted values from that regression as our measure of non-discretionary component. Then you take the average of this non-discretionary component from quarter T-3 to quarter T. So last 4 quarter average of this non-discretionary component as our measure of expected loss. Once we get these 2, we calculate the forecast error term. So how should this forecast error term look like if expectations are rational? It should be something like this gray line. So in this figure, the blue line plot average loss that banks experienced in the recent past from quarter T-3 to quarter T. So this is, we call it current loss. So this is basically average past loan losses. If banks' expectations are rational, this forecast error should not have any relation to these past loan losses. It should be unpredictable. How does the actual forecast error look like? It is the red line here. So apart from this brief period of anomaly during the crisis, we find there exists a pretty strong negative relationship between these 2. The forecast error are not exactly random. They are predictable from past loan losses. So what drives this negative relationship? Let me explain that through this empirical specification. We simply regress the forecast error on current loss, which is the average of loss over the last 4 quarters. If expectations are rational, as I said earlier, the coefficient beta, it should be indifferent from 0. Now let's say the bank today experienced an unexpected increase in current loss. The bank must have received some bad information from it. It is going to revise its expectations about future loss upward. So expected loss goes up. Now, after this revision, if actual loss turns out to be lower than what the bank had predicted, actual loss would rise. But the rise in actual loss, if it not as much what the bank had predicted earlier, forecast error is going to decline. That gives rise to a negative relationship between current loss and forecast error. So what is happening, essentially, the bank in the first place overreacted to this increase in current loss. So when the bank overreacts to current condition, you would see a negative beta 1. The coefficient turns out to be negative. And consistent with our inference from the figure, when you regress the forecast error and current loss, the first row you put the coefficient beta 1, we find it turns out to be negative. So what it says, if in the recent past, banks see a 1 percentage point increase in current loan loss, they are going to overreact to this negative development, overestimate future loss by say 0.373 percentage point. And that leads to a predictable decline in the forecast error. So what's the next best alternative that can explain this overreaction? For that, we are going to rely on a mechanism proposed by Bordalo and others. It is based on Kahneman and Tversky's representativeness heuristic. So let me skip this slide. I will explain this through an example. Let's say you are conducting a survey. You are asking a person, what kind of sports do you think people like in India? Let's say there are only 2 options, cricket and football, and everyone strictly prefer one to other. Since cricket is more popular in India, let's say 70% of India's population like cricket. Now compare this to the rest of the world scenario where football is more popular. So only 10% of rest of the world's population like cricket. If you compare these 2 pictures, you are 7 times more likely to find a cricket-loving person in India compared to rest of the world. So cricket here, I can say, is a representative feature of India's population. And what Kahneman and Tversky from their experiments showed, people have a tendency to overestimate the probability of representative traits. So the person is going to say the probability of finding a cricket-loving person in India is something like this. It is the true probability multiplied by the relative likelihood raised to the power theta, where theta measures the extent of overreaction to this representative feature. Now, what does this mean for our context? In our setup, the bank is predicting tomorrow's loss ZT plus 1 after observing ZT. So if bank's expectations are also shaped by representativeness, the bank is going to inflate or overestimate the probability of those states of GT plus 1. So GT plus 1 can take different values from 0 to 1. The bank is going to inflate those values of GT plus 1 that have become more likely in light of the information it receives from ZT. So when the bank observes ZT, the only new information it gets from ZT is this epsilon shock. So if this epsilon shock is positive, the bank is going to overestimate GT plus 1. If this epsilon shock is negative, the bank is going to underestimate future loss or GT plus 1. And this is the equivalent expression for that. So how does it look like? If you could imagine that the credit loss process evolves like this. It's an neuron process. Let's say it evolves like this. If at time t the bank receives some epsilon shock, say this epsilon shock is positive, today loss turns out to be higher than what the bank had predicted earlier. The bank is going to revise its expectation about future loss GT plus 1 upward, and the mean would increase by rho into epsilon t because it's a neuron process with persistence parameter rho. So the bank revises its expectation about future loss upward. Now this is what a rational bank would do. But a bank that has overreaction bias in its expectation is going to overreact to this information, and the distribution would further shift rightward. So there would be an additional term plus theta comes here, and the mean would increase by an additional theta rho epsilon t. If the bank in our sample is forming expectation in this manner, so expected loss gets modified. This
Arpit, you have 5 more minutes. Thank
okay,
you.
sir. This theta rho epsilon t comes here. When you take the difference, the forecast error, it turns out to be like this. Now, if we regress return current loss, this forecast error is predictable, and the coefficient beta 1 turns out to be negative, which is what we observe from our empirical analysis. So the last thing we're going to do is to embed this modified expectation in a standard DSG model with dynamic provisioning rule and derive its implication for credit cycle. It's a standard macro model where there is a commercial bank. It makes loan to a capital good producer. We have only modified the bank's expectation. Rest of the agents in our model have standard rational expectations. So I'm going to focus only on the problem between the bank and the capital good producer. The bank, it makes loan to the capital good producer. It decides what lending rate to charge, and it also has the option to monitor a fraction of its loan. We assume that monitored fraction doesn't have any default risk, but the part that is not monitored, it can default, and the default follows the earlier AR1 process. So the expected interest income from the loan can be written as total rate the bank charge, size of the loan portfolio into, so this term in the curly bracket shows the fraction of loan that the bank expects is not going to default, which is affected by this bias term. The second place where bias comes into picture is provision. So in our model, the bank also keeps provision. When it makes a loan, it forms expectation what fraction of loan is going to default, and it makes provision for that part. So it is the non-monitored fraction of the loan into bank's expectation about future default. So for the time being, if you assume this lambda term is 0, this term drops down, you only have this term et theta GT plus 1, which is equal to bank's expectation about future default rate. What lambda does here, it is basically a dynamic provisioning parameter. If you set lambda some positive value, the bank is going to keep some extra provision during good time. Now, this is something similar in principle to expected loss approach, where the banks are expected to keep extra provision during good time. The bank in our model, every period, it sets the lending rate and monitoring to maximize its profit. So we solve for the bank's function, objective function, and we derive condition for lending rate and monitoring. So this is the first condition with respect to lending rate. There are 2 ways where expectation is going to affect bank's decision on lending rate. One is income expectation and this provisioning questionnaire. When the bank expects a higher fraction of loan to default, marginal benefit of each unit of loan goes down. This is basically the interest income that goes down. Bank is going to charge a higher lending rate to compensate for this risk. And also the provisioning cost for loan goes up, and the bank is going to pass on that cost to the borrower. So both these channels basically increases the lending rate. What does bias do? Let's say today the bank receives a positive shock, default turns out to be lower. Then the bank that overreacts, it expects a lower fraction of loan to default relative to a rational bank. So the bank is going to charge a lower lending rate compared to a rational bank. And in bad times, the bank is going to do the opposite. The bank that overreacts is going to charge a higher lending rate relative to a rational bank. in a general equilibrium model that translates to higher lending, more investment, more output during good time, and severe contraction in lending, less investment, and less output in bad time relative to a rational bank. For monitoring, we also, I'm not going to spend time on this. We also get similar results. The bias again leads to, since the bank that has overreaction bias, it is too optimistic about the future, the bank is going to reduce its monitoring level in good time. So basically it is going to lower its lending standard, and the bank that has overreaction bias is too pessimistic about the future, it is going to increase its lending standard in bad time. So what is the implication for financial regulators? Let's say there is a financial regulator that wants to minimize the volatility of credit to output ratio, or it has a mixed objective function, some weighted average of volatility of credit to output ratio and volatility of spread the bank charges over the risk-free rate. So here in this plot, on the x-axis, we have this dynamic provisioning parameter. We vary this lambda, and on the y-axis, we plot this loss function, this volatility. The blue line is for rational expectation, and the red line is for overreaction bias in expectation. As you can see, the point at which this volatility is minimized is higher for a bank that has overreaction bias. When the bank overreacts to any exogenous shock, it introduces excess volatility. So we need to set a higher lambda to counter that excess volatility. If financial regulators are working under the assumption of rational expectation, they would set a lambda somewhere here. And if banks don't have rational expectation, final result will be somewhere here. So that's the key result we want to highlight. Dynamic provisioning rules, they need to take into account the underlying behavioral bias or the underlying overreaction bias that banks have in their expectation. Working under the assumption of rational expectation will not deliver desired results. Now, currently, we are working on this expected loss approach rule. In the paper, we have considered dynamic provisioning rule, which is although similar in principle, the actual rule is a bit more complex. So we are trying to bring in more intricacies and hope that can give us some more insights. Thank you.
Thank you, Arpit, and thank you very much for keeping perfect time. Okay, this is to ask all people who are attending this session to please type your questions in the chat box so that I can convey them to Arpit. Okay, currently I don't see any questions in the chat box. Okay, I see some now. Okay. Just a minute. All right, I'm just having a little bit of problem in scrolling down. Okay, just a minute. Yeah. So the main point that one of the questions is bringing us that the R-square of your empirical analysis was around 0.26. Isn't it too low for a model to be a good fit? This is one. And the other that is coming up is your forecast error. There seems to be some in the LLP equation. How robust is your expected loss LLP equation? There seemed to be some persistence in this. If you include dynamics in the main equation, expected loss might not be underestimated in that equation, as the forecast error is very low. The forecast error seems to be close to zero. Is that correct?
If you take the average over the entire sample period, yes, it will be very close to zero, but there is significant heterogeneity across time. So in good time, we see the forecast error is less than zero, and in bad time, it is the other way around. Yes. Yes, I saw the question. I can take those two questions. So the first question about this forecast error being very close to zero, yes, we agree. On an average over the entire sample period, is the forecast error is zero, but the objective is to study the variation in forecast error over time. So in good times, when we see the forecast errors are negative, banks are underestimating loss. Sorry, when we see forecast error is positive, banks are underestimating loss. And in bad time, when we see the forecast error is negative, banks are overestimating loss. So the objective is not to say whether the forecast error will disappear or not. It tells us this variation in forecast error tells us something about banks' expectations, what banks thinks about the future. And we are trying to study the repercussions of that thinking on credit cycle. And the second question about the R-square empirical analysis, yes, this 26th version, the R-square we find is, I agree, it's not good for a model to be a good fit. But again, we are not trying to predict forecast error. Our objective is whether forecast errors can be explained from past data or not. So whether the forecast error is random or not. So that's what we want to test, whether though it has any relation with past data or not. If expectations are rational, the forecast error should not have any relation with past loan losses, which is the information that banks have when they made the forecast. We are not exactly trying to predict the forecast error. So, yes. When you say bank expectations, whose expectation is it? So the next question is from Asima ma'am. When you say bank expectations, whose expectations is it, the management board or the risk officer? Ma'am, we believe this is expectations of bank managers because they are handling in maybe management, and also risk officer maybe is involved, because these two parties are responsible for assessing the credit risk of a loan portfolio and recognizing loss on the loan portfolio. The board might not comes into the picture, so it is management and risk officer.
Okay. So can you just explain once again as to why the loan loss provisions are not considered directly and why you have to adjust them? Because window dressing is possible for a large number of variables, including loan loss provisions. So, and there are standard models that help you model this, right?
Yes. So what exactly we do here, basically we take the observed loan loss provision and we regress it on the set of variables that include various measure of non-performing assets, loan growth, net charge of all these things. And we take the fitted values as our measure of non-discretionary component. So as you said rightly, managers are involved in window dressing. They want to smooth their income, signal to the stock market of a favorable reaction. They do all sort of things, and that's affect this provision to deviate from expected loss. So we considered in the paper several alternative models, and we also conducted type 1 and type 2 error test. Which model is falsely reject the null hypothesis of no earnings management, which model accurately identifies the earnings management. And after considering all these things, we consider this model performs the best in separating this discretionary component that gets polluted.
Okay. So there is another question. What type of loans, public companies versus private companies, would you assume to have higher forecasts? But this is American data, right? So
this is American data, yes. So what types of loans would you assume will have higher forecast errors?
Right.
Again, I don't know, because we only observe the aggregate values from banks' balance sheet. And again, the provision when the banks recognize, they don't do it loan basis, they just recognize the aggregate amount. So you cannot exactly identify between public and private companies whether this loan loss provision is made for a particular loan that has been given to public or private companies. But if I have to speculate, I might say it may be for private companies, the forecast error will be more cyclical, because for public companies, lots of information are available there in the market. It might be easier for banks to evaluate those loans, but for private banks, banks have to rely more on their discretion. So I guess the expectation banks are going to make more mistakes on the loans extended to private companies. Again, that's just speculation. I'm not sure.
So Professor Ashima Goyal has posted another question, but there normally is correlation across banks because market expectations tend to overreact. So,
but there normally is correlation across banks because market expectations tend to overreact. If I understand the question correctly, yes, banks tend to overreact. There exists correlation between banks. They tend to overreact simultaneously in good times. When things are going good, almost all the banks are experiencing less loss on their loan portfolio. That's the time banks keep less provision, and we can find correlation between them. And that's also something consistent with the figure. This figure is basically average across all banks. And as you can see, during recession, this forecast error. So when the recession starts, this forecast error seems to go down. So basically banks are overestimating future loss. Expected loss is higher compared to actual loss. So the difference goes down. And in good times during boom period, banks are underestimating trading loss. They're keeping less provision, and actual loss being higher, this forecast error seems to move up during the boom period. So this is taken, so these figures are average across all banks. So you are right that banks, there exists correlation. It seems consistent with this figure. During good time, on an average, banks are overreacting to good conditions, keeping and too optimistic about the future. And during recessionary periods, during bad time, on an average, all the banks are too pessimistic about the future. They are overestimating loss, and forecast error seems to go down.
Now, if there is correlation across banks, does it affect the estimation of the model?
So we run this panel regression, and we have done several robustness checks. We considered bank fixed effects to account for any unknown heterogeneity. And also our standard errors are dually clustered on bank and time. So it allows for the errors to be correlated across banks and also across time.
Okay, so
yes.
that is important, right? Because your model allows you to take care of this.
Take care of this. Yes.
Okay, so I think you have ended at exactly the right time. So thank you, Arpit, for an excellent presentation. I really enjoyed both reading your paper and listening to you. And now I would like to invite Dr. Sriniwas Mahapatro to present his paper, Indirect Evergreening, Using Related Parties, Evidence from India. You have 20 minutes. And I request all the participants to post their questions on the chat box. Thank you. You can start.
Okay. Thank you, Dr. Rajendra. I'm Sriniwas. This is a co-authored paper with Nishant Kashyap and Professor Prasanna Tantri, all of us are from Indian School of Business. The title is Indirect Evergreening Using Related Parties, Evidence from India. First of all, the main motivation behind this is the phenomenon of evergreening, or zombie lending, as it is called. In that, what usually happens is a bank which is thinly capitalized, or you might also vaguely say is a bad bank, usually kind of provides a new loan or restructures the loan of a borrower which is almost insolvent, trying to keep it alive. In the process, it kind of underreports the NPA and postpones loan loss recognitions. So that's the evergreening that has been talked about by a couple of papers from Dr. Acharya, then Peek and Rosengren. In this paper, we are trying to identify an indirect way of evergreening. Here, a low-quality bank lends to a related party of an insolvent borrower and then facilitates the movement of funds to the intended beneficiary. So it's similar to evergreening, but rather than directly handing over the fresh funds to the insolvent borrower, it does it through a related party, which in turn, again passes on the funds to RPTs. And why should we study it? Well, for starters, evergreening has been one of the reasons for bank collapses in the past. And what we are trying to identify, it is different from evergreening, direct evergreening. This indirect evergreening is actually harder to detect and prevent. And basically the motivations as well as the economic impacts could be different. I would try to show it to you in a pictorial presentation. It looks a little complex. I'll try to make it simpler. First of all, we have a bank and an initial borrower which already are there in a lending relationship. Now, when this bank is not of good quality, low quality, and this borrower is also facing insolvency, at that time, what we see is this low quality bank actually extends a new loan to a subsequent borrower, which happens to be a related party of the initial borrower. And then the subsequent borrower kind of transfers a part of the loan to through related party transactions to the initial borrower. And of course, the initial borrower kind of pays it back. Even though initial borrower is under distress, it is able to pay it back, and it doesn't actually, often, faces a default. So this cycle is what we call as indirect evergreening, or rather suspected indirect evergreening, because some of it could be legitimate transactions, but we also show that most of the transactions actually have something fishy about them. The next step could be the initial borrower kind of recovers, it pays back the money to the subsequent borrower, and subsequent borrower, in fact, repays the loan to the low quality bank. That's all rosy. But what we find evidence is in these scenarios, although the initial borrower kind of doesn't default, despite being, having insolvency issues, the subsequent borrower actually defaults in the future. And, so basically the bank has actually, shifted from having exposure from one borrower to another borrower, and basically maybe delayed the recognition of loans. Yeah, it was actually, one of the motivation was this HDIL case where, there was, I think, whistleblowers from Maxstar Marketing, where they mentioned that, a part of the funds that were given to Maxstar was actually diverted to HDIL, which was used to repay the loans to Yes Bank. And this is not one instance. This was, I think, 1.5 years ago. There have been several instances in this last 1 year where the RBI has categorically mentioned that RPTs are being used to, do such divisional actions. I'll quickly go through the main results. The first result we find is that basically low quality banks are more likely to lend to related parties of insolvent borrowers. Good quality banks are not so highly likely, do not have a higher likelihood of lending to related parties of insolvent borrower. Second thing is the related party that receives the connected loan, although whenever a firm receives a connected loan, ex ante it is expected that it will invest more. But what we find is they invest less, and we also find that a statistically significant amount of RPT is being passed on from that related party to the original borrower in trouble. We also find that the related party that was used as a conduit is actually defaulting much, has having a higher probability of default as compared to its peers. And the whole transaction, we find that this is actually not so easily catchable by regulatory audits as well as by markets. The main advantage for the bank is, of course, to window dress their books, and there is also some suggestive evidence we find regarding post-retirement concerns. The major impact of evergreening, indirect evergreening, is similar as what was studied in Acharya et al. We find that the higher evergreening industries, although they get a lot of credit, there isn't as much investments being done. And if you fund this indirect evergreening, of course, it is at the cost of some other good firm, so there is a crowding out of investments from good firms to these firms. And finally, we try to address that this is not the same as usual banking transactions, because they have lower return and higher risk, and they are categorically being done by the bad quality banks. So that is to address concerns. The main strand of literature that we address to is identifying evergreening of loans, or zombie lending, you can say. Peek and Rosengren, Acharya et al., also Bonfim et al., they talk about it. Then we also talk about role of regulators in facilitating or curbing evergreening. In direct evergreening, literature has also talked about that sometimes the central government or the government itself actually tries to especially during regulatory forbearance period, they encourage evergreening, and there are some times when they totally crack down on evergreening, like the post AQR period, the asset quality review period, in which RBI had done. So and the third literature stream is the related party transactions, because we find it that this is the essential stream through which this indirect evergreening happens. Some definitions and key variables. I won't go through all of them. I'll just talk about a few. One is the initial borrower. Initial borrower is, a bank already has a relationship with the borrower. A subsequent borrower is a related party of the initial borrower, which also gets a loan from the same bank, but later on. A connected loan, we have this indicator is set to 1 if a loan given by a bank to a firm whose related party has an existing loan from the same bank. So basically, when the subsequent borrower gets a new loan, it is called as a connected loan. A direct evergreening indicator, which Acharya et al. And Peek and Rosengren already talked about, we say that it is set to 1 when a firm which already has an ICR less than 1 gets a new loan or gets a restructured loan from the existing banker. Indirect evergreening is set to 1 when 3 criteria are met. One is the borrower is in trouble, Second is the bank is a low quality bank. And the third is there is a connected loan to a related party of the borrower in trouble. When all the three criteria are met, we call it as an indirect evergreening indicator. Now for borrower in trouble, we use the interest coverage ratio less than 1. That is a standard measure. We also vary this for leverage and sales growth and other in our robustness test. For low quality bank, we use the indicator is 1 for creditors with above median average exposure to firms which have interest coverage ratio less than 1 in the previous 3 years. Now here we have used a measure which is representative of the portfolio of the borrowers that this bank has. We haven't gone with the usual measure, that is capital adequacy ratio, because for our sample period we have a huge, a long period of forbearance period, where actually the AQR was not a good measure. Basically, when you were readily allowed to restructure loans to bad quality borrowers. In fact, we all are aware that some of the banks which had very high capital adequacy ratio actually faced a lot of trouble recently. So we use a measure which is representative of the quality of borrowers, underlying borrowers of the bank. So of course, the questions would come about data set. So we use the Ministry of Corporate Affairs data set for the loan level data. This constitutes around about more than actually 50% of the 50% of the corporate credit which are secure. And then we have CMI Provis, which has RPT data and bank and firm data. The default data we get from TransUnion CIBIL, and our sample period ranges from 2006 to 2020. The asset quality review period, which started for the financial year 2015, it started from 2016 to 20. Right. So I'll explain this later. Yeah. So the first evidence of evergreening. So first, what we show here is basically the probability of having a connected loan is higher when the bank is a low quality bank, as well as the initial borrower is in trouble. That is, when a bad bank and a bad firm which have an existing relationship, they pair up, the probability of connected loan is much higher. The percentage here is 1.2%, the unconditional is 8 something. So it roughly translates to around about 14%, in terms of economic magnitude. We also show that this connected loan is almost always to good quality subsequent borrowers, not to bad quality subsequent borrowers. So after establishing that, okay, a bad bank of a bad borrower gives a connected loan to a related party, that doesn't prove anything. So we go to the next step where we talk about the RPT. So in RPT, we show that the RPT here, this is the RPT from the subsequent borrower to the initial borrower. We find that the RPT loans, RPT investments, RPT inflow, even the sum total of absolute value of RPT, this is significantly higher for indirect evergreening transaction. In fact, RPT loans are as high as 25%, and our total RPT goes up as high as 28%. So what it means is subsequent borrower transfer funds to the initial borrower through RPT loans and investments. So this is the complete cycle that we talked about. As I said, if I had to put it in one line regarding connected lending, low quality banks are more likely to lend connected loans to a related party of an existing borrower in trouble. After this, subsequent borrower transfer funds to the initial borrower through RPT loans and investments. Now, to suggest that this is actually evergreening, because this circle of transactions could be very, very legitimate, to show that there is at least some of it is evergreening, we try and investigate the investments. We find that we first of all we go to the subsequent borrower. Now, subsequent borrowers are the recipients of this fresh loan. So basically, ex ante, if they receive fresh loans, their investment should increase. But what we find is their investment actually decreases by 15 to 17%. Then we go on and check the investment by initial borrowers. Although initial borrowers got a huge amount of RPT, still their investments is also significantly ranging from 30% to 49%. So neither the subsequent borrower are investing nor the initial borrower are investing. Although the former gets a new loan and the latter gets an RPT, they are not investing. So that's where our first doubt comes in, that where is this money going on? Second, we try to check the loan performance of subsequent borrowers. So basically, if subsequent borrowers are used as conduit for passing on the funds, and if they are not utilizing the funds, then they should default to the loan in the future, and they should default towards the loan. So to assess that, we use a Cox hazard regression model where we find that the hazard ratio for subsequent borrowers or related parties which are acting as conduits for indirect evergreening, they have a hazard rate of loan default at least 50% higher as compared to other comparable loans. So which means that these they mere act as conduits and they have a higher likelihood of default as compared to other comparable loans. Now we also come to the loan performance of the initial borrowers. For loan performance of initial borrowers, we find that what we do is we compare these initial borrowers who have a low ICR and are evergreen with initial borrowers who have a low ICR but are not evergreen. So if the first row actually shows that the low ICR not evergreen, they still go on and default, which makes perfect sense because they are having insolvency problems. So they are, they are defaulting in the year or the next year. But this indirect evergreening indicator, the firms which have low ICR but are beneficiary of indirect evergreening, they don't default as much. Their coefficient is insignificant. Next, we come to interest rates. Interest rates data is not directly available. There is a final and aggregate interest rate available. So we try to impute it, and this is more of a suggestive evidence. What we find is the interest rate of SIE loans is lower than other loans even after controlling for size, performance, and credit rating. So all these evidences, and after this round trip of the funds, what we find is there is no investment by both the parties. Subsequent borrower defaults. Initial borrower, although under distress, is not defaulting, and the interest rate of this loan is lower. So this is what gives us this idea of that this is possibly a suspected evergreening transaction. Now, what are the alternative explanations?
Sriniwas, you have 5 minutes left. Thank you. Sorry for the interruption.
Okay. So alternative explanation is there could be cases that this is just a normal transaction. We try to rule out the few things. We are seeing that good quality banks don't do this. Second thing we find is that the banks which have been exclusive banker of the subsequent borrower, they are not engaging it. They have a lower likelihood of giving a connected loan as compared to the bad quality bank of an initial borrower in trouble. That helps us deal with the alternative explanations. Detecting indirect evergreening, I'll give one example here. So there was this asset quality review exercise which was done by RBI from 2016 to 20, where they recalibrated the provisioning of almost all the banks, and more than a dozen banks had to re-report. So we take the provisioning divergence and we regress with direct evergreening and indirect evergreening. So we find that although the AQR exercise is able to predict direct evergreening, indirect evergreening is mostly insignificant. Similarly, we don't find any reaction from financial markets or depositors. The motives of indirect evergreening, this is basically a window dressing of banks, because you are, from a bank's perspective, you are replacing a bad quality borrower with a good quality borrower. So obviously the underlying of, the underlying quality of the borrowers will improve. So you might have to make lower, provisions, the credit, the risk-weighted asset ratio will reduce, and you might have to do less amount of provisioning. In terms of impact of indirect evergreening, this is very important, because this is in line with what Acharya talks about in direct evergreening. We find that the credit is higher to indirect evergreening industry, but the fixed investment is totally counterintuitive. It is reducing. And second, we find that the credit flow to higher sales growth firms, that is basically the firms which are deserving, they this indirect evergreening loans actually comes at the cost of them. They are the ones who are suffering. Similarly, we also find that eventual stock crash using Kimley and Chang is basically the probability of an indirect stock crash is higher for banks which have a higher amount of indirect evergreening as compared to other banks. In conclusion, we talk about another way of evergreening, which we call it as suspected indirect evergreening, where a low quality bank gives a new loan to a related party of a borrower in distress, and the related party transfers the fund through RPT. There is less amount of investment, and the related party actually defaults more, but the initial borrower in trouble defaults less. We find that the major motive behind this is the window dressing of the bank's books, and we also find that it is associated with a higher probability of stock crash, and there are real effects in terms of firm and industry level. That's all I had. Thank you. I'm open to questions and comments.
Thank you, Sriniwas, for keeping excellent time and making a very nice and clear presentation. So let's open the chat box.
Yes, I have. Yeah, I think.
Considering after AQR, the extent of evergreening may have gone down, and also provisioning by banks may have changed. How would your results change if you end your sample in 2015? This is Rajeshwari Sengupta.
Yeah, if we end at, we did this as a robustness test, it still happens. If we end our sample in 2015, what we see is both direct evergreening and indirect evergreening are prevalent. But after 2015, what we see is the direct evergreening has reduced to an extent, but indirect evergreening has not. There is another question, I think, from Professor Sima. Regulatory arbitrage is a natural cycle, right?
No, this.
Okay, are you able to explain why indirect evergreening go? Yeah, indirect evergreening doesn't go down after AQR. What we mean is indirect evergreening is still there. It doesn't change. Only the direct evergreening changes. Direct evergreening is where you are just extending, a new loan to a borrower who's having liquidity issues. So that was really cracked down upon, and where more provision was, at least the banks were asked to provide more for them. But indirect evergreening, we do not find any evidence that it is getting affected by AQR.
So let me just take advantage of being the chairperson of this session. You see, in the Companies Act, there are very strict provisions for intercorporate loans. Have you seen them?
No, Professor.
I think you should go and see them. They are very, very strict. So, in fact, if any of those rules are broken, it is considered to be a criminal case, and the board of that company can go to jail. Okay, this is the first thing. The second thing is that if a firm gets a loan, why should you expect its investments to rise? In the uses of funds, investment is one particular option, right? It needs funds to run its current business. So, I mean, linking bank loans to investments, when our understanding of what triggers investment is rather nascent, I would say, in the Indian context. So I don't think that is a very persuasive argument. Right. Over here, we have a question which says that lending could be for working capital too.
Yeah, right. It could be. So there is no, in the absence of any other measure, we are, then what my answer should be, investment should be insignificant. It should not decrease. For these things, I mean, there should be a gradual rate of investment, right?
No. There is nothing in the literature which says that when investment should rise, when firms should grow, when they should fall.
But Professor, falling in investment significantly.
It's standard. Look at the data on firms closely. You will find many firms who decrease in size. There is no problem in the data with that.
We call it as a suspected indirect evergreening, but there is no other way to actually track where the fund is going. I mean, I can do it on the working capital. I can regress it.
Right, but I think more attention needs to be paid to the Companies Act. Okay, because I am not persuaded that just because there is an intercorporate loan, okay, there is a problem. Because the rules governing intercorporate roles in our country under the Companies Act have been made very tight. Now, if you have evidence that those rules are being violated, that is a very serious matter. Because, but standardly audits will catch that because it is such an obvious thing. So I think you should just inform yourselves about and they have changed between the two Companies Acts.
Right.
They have been made more tighter in the more recent Companies Act.
Apart from RPT loans, we also find evidence in terms of RPT investments going up to 50% higher.
That is fine. That is fine. But these are legal niceties which are there in place, which try to discourage this kind of thing. Whether that is successful or not, we don't know. But it's just where is this?
Rajendra, you can maximize the chat window and then you'll be able to see all the questions.
I'm doing that, but I can't.
Do you want me to just ask then?
Sure.
One more thing, wanted to point out. We actually did for the Economic Survey of India. We published one of our results for indirect evergreening, and we found out that in terms of ranking, the highest percentage of indirect evergreening was present in Yes Bank, and the third highest was Lakshmi Vilas Bank, which they actually eventually published in the survey. And it was and I'm not talking about forward-looking data, but it is before that AQR, just up till 2016 and 17. So that kind of motivated us actually to go ahead and maybe really look at what else is going on. So this is in response to the, I think, the third comment which Rajesh shared.
Yeah, got it. So Sriniwas, there's a question. In the absence of a strong insolvency system, that asset diversion can occur. So with a strong bankruptcy system, which includes stronger creditor rights, then these related party transactions can decline if you include post 2016 data. So
yeah,
would you say to
but we don't, we also do it for 2016 to 20. It doesn't seem to be reducing. It is if that connected loan and RPT regressions, if I kind of rerun for just a sub period, we don't find it reducing. That's true. That is what one of our major takeaway from this paper was. It is still not detected in all the cases, or not prevented. So so as a prescription, we are also kind of advising on looking at the RPTs more closely when providing a new loan.
Okay, there's one question. The regulatory arbitrage is a natural cycle. Tightening follows arbitrage. Rules on related party transactions have been strengthened. So can you control for that or have dummy variables to capture that effect?
Pardon me, regulatory. So control, I'm sorry, I couldn't understand. Control for what actually?
So I think what Professor Goyal is trying to ask is if there has been any strengthening of regulations and rules against related party transactions. Are you able to figure out when that happened and then control for that?
Okay, yeah, that sub period we have not taken. I think it's a good question. I will have to go ahead and check. Maybe post. It would be nice to see if in the cross section, post strengthening of some RPT rules, maybe if it reduces or so. I think yeah, I think that's something I can go ahead and try.
Rajendra, over to you.
Yeah, thanks. I don't see.
So if there's no other question, I'll just follow on what Professor Sushanta Malik asked. So Srinivas, so while you may have done the sample from 2016 to 2020, but see, it is definitely it's a valid concern that despite having a very strong insolvency and bankruptcy code which strengthened the creditors' rights, at least from 2017, end part of 2017 onwards, if you are still not seeing any change in your result, then it would be interesting. But how would you explain that you have a regime which is strengthening creditor rights, but you're still not seeing any reduction of the indirect evergreening? How would you result?
Right. So I think Professor Sushanta is referring to maybe IBC. So the thing is, even if you go to it depends on the cost and benefits. If I am a bank and I know that this loan is done for, and I can either take the loss and drag it to IBC, or I can maybe do this indirect evergreening. What I believe is, even if you go through to IBC, it's highly unlikely that you will recover maybe 100%. It depends on the bank's prerogatives also. If they have enough buffer to actually take losses, maybe they will do it. If they don't, maybe they'll find that if I take to IBC, still the amount of loss that I will have to incur is much more than the benefit which I get temporarily from this maybe evergreening transaction. And possibly there is also a possibility that that genuinely maybe the firm will turn around and I'll recover maybe 100%. So I think there's that thing is also issue is there as one of the constraints.
Yeah, I can see that, one Mr. Anil Katia, I am an insolvency resolution professional. The intercorporate loan provisions in the company tax are being circumvented and related partnership transactions are being undertaken very often by borrowers, causing loss to it. No one is enforcing violation of Companies Act. I mean, but what are the auditors doing then? I mean,
So I think this is in line with the kind of what I'm also suggesting, that related parties are being undertaken by very often. I think as soon as last month only, the RBI governor also gave in a particular space saying that related parties transactions are being flouted. So maybe, but again, I mean, this is something I think we can take as a policy prescription, saying that have a closer look at, or perhaps get in some.
No, you will have to penalize the auditors, right? So if there is a violation, the auditors have to point it out. I mean, you'll have to blacklist the auditors for not doing their job. Okay. Because, that is a provision in the Companies Act. So if that provision is violated, it is a criminal. It's not even a civil suit. It's a criminal suit.
I understand, Professor, that, investment could also be a coincidence. I mean, having, so many things in the same time. So maybe that's why, in fact, we came back to the name as suspected indirect evergreening rather than indirect evergreening. So,
okay. So we just have a little more time left. So let's wait. What is the share of PSU banks in this indirect evergreening?
I haven't actually done this. I don't have it at the top of my mind. But when we rerun this test only for PSU, still it holds. If that is the question. But yeah, I mean, this I don't have.
Okay. Right. Okay. Thank you, Sriniwas, for a very lively discussion and an excellent presentation. I really
thank you, Dr. Rajendra. Thank you for the comments. Thanks.
Yeah. Next, I call upon Dr. Shreya Biswas, Bank Board Network and Financial Stability in Emerging Markets. You can start, Shreya. You have 20 minutes.
Yeah. Good evening, everyone. So this is a joint work with Rajneesh, Kumar. So coming to the motivation of this paper, so banks as institutions, as we all know, are heavily regulated, and their operations are much more opaque compared to non-financial firms. And hence, the corporate governance of banks requires special attention, and this has been highlighted in the literature as well. Also, a review paper on corporate governance of banks have mentioned that the future research on the importance of corporate governance for banks should especially consider what is the role of director networks. So that is exactly what we try to address in this paper. So there are a couple of papers that tries to understand what is the role of director networks or CEO networks in the context of US. So one is the DeBock et al. Paper 2020. So they basically look at the CEO networks for banks. On the other hand, another paper by Abdul Badi and Salama 2019. So this is the only paper that talks about the role of director networks for US banks and how that is related to bank outcomes. When we look at the literature in the context of emerging market economies, it is still not really, so we do not find many papers here. So why it becomes important to focus on emerging market economies separately? So the idea is that an emerging market economy like India typically has a bank-based financial system, unlike the market-based financial system in the context of US. So given this background, in this particular study, we are interested to understand how the interlock-driven board network for banks is related to financial stability in the Indian context. So coming to the theoretical framework, so basically there are two theories. The first is the agency theory that tries to link what could be a possible relationship between board network and a bank outcome through the board effectiveness channel. And the other predominant theory is the integrated resource dependence theory. So a large board network is formed when directors sitting on the board of the bank occupy multiple board seats. So according to the agency theory, so it basically tells us that when we have directors who occupy multiple board seats, so these directors become busy. Also, at the same time, they have a lot of connection, which kind of ensures their career advancement. As a result, these directors could become weak monitors, and weak monitors will eventually reduce the effectiveness of the board, which in turn could be detrimental for financial stability of banks. On the other hand, the other view is the integrated resource dependence view. So according to this view, it actually takes a very different position and proposes that these well-connected directors are actually well reputed in the directorial labor market. So they have a reputation which they want to protect essentially. And as a result, they would actually become better monitors. Secondly, this theory also talks about the availability of resources. And these resources are typically non-market information that the bank can access because it has a director that occupies multiple board seats. And finally, these directors that sits on various boards is kind of a proxy for their expertise, and because of their higher expertise, so these directors are going to be the good quality directors, and these three together will kind of improve the effectiveness of the board and in turn should be related to better financial stability. So these are the two competing theories that we intend to test empirically. So specifically, we want to study the relationship between board network and financial stability of Indian banks. Then we also want to understand whether the relationship kind of differs based on ownership type. And also we can examine what are the possible channels that are driving the results. Right, so preview of findings. So in our study, we find that bank board network, so a larger bank board network improves the financial stability of banks. And when we talk about financial stability, so we use asset quality measure, then we use the insolvency risk as well as the volatility of ROE. We also interestingly find that this is not at the cost of performance, or in other words, we find that these banks, so banks with a larger board network, also perform well. So when we use performance indicators like ROA and ROE, so these banks also exhibit superior performance, indicating some evidence in favor of the integrated resource dependence view. So because if it is due to the resources, that should help in improving performance as well as to improve the financial stability. Further, we find that the results are largely driven by the private banks. And we examine two possible channels. One is the possibility of better monitoring of borrowers, and the other is the access to soft information, which is proxied by the number of loans restructured by the bank. So overall, our findings are in line with the integrated resource dependence view of the board. And our results largely suggest that having well-connected directors can improve the resources and the strategic advice that is available at the board level. So contribution. So our study contributes to the corporate governance in banks literature in the context of bank by examining how board network affects the financial stability of banks, especially in the context of an emerging market economy like India. We also contribute to the social network literature by finding empirical evidence that social networks do matter for transmission of information in the context of financial firms. Coming to the data, so we consider the sample of listed banks in India for the time period 2009 to 2019. The financial data is obtained from Kravis, maintained by the CMIE. The board level data we get from the Indian boards database. So this database gives us the board composition along with the appointment and cessation date. So using the appointment and cessation date, we are able to trace out the network till 2009, and that's why we can only go back till 2009. So the information does not allow us to go back further in time. So this is just a pictorial representation of what do we mean by network here. So suppose we have a bank like the City Union Bank, and a few of its directors also sit on different companies. So the City Union Bank becomes directly connected to 10 other firms because of sharing of both seats. So this is what we call as the first level connection. Additionally, we also account for indirect or second level connection. So indirect or second level connection is, say, because a director sitting on company 10 also sits on another additional company. So at the second level, City Union Bank is additionally connected to 32 more firms. So in our analysis, we consider both the first or the direct connection as well as the indirect connections due to board interlocks. Variables. So financial stability variable, as I mentioned. So first we consider a couple of asset quality measures. So the first is GNPA to loans and advances, and the second one is NNPA to loans and advances. We also consider the insolvency risk, which is given as the negative of the log of Z score. So the Z score defined in the literature is the ROA plus your capital adequacy ratio divided by the volatility of ROA in the last 5 years. We also directly take into consideration the volatility of ROA as an outcome variable. Coming to bank board network variables, so we use the Z score of the centrality measures. So the centrality measures that we use are standard in the literature. So first is the degree measure. So this degree measure basically gives us the number of connections that I was just showing. So we call degree 1, which is basically the number of direct connections, and degree 2, which is the number of indirect connections. So the first measure is kind of a proxy for the quantity of information that is available to the bank because of the network. The second measure is the eigen measure. So this gives us how well connected are the connections of the bank, and it is a proxy of the prestige or power of the bank in the network. The third one is what we call as the closeness measure. So closeness measure is the inverse of the sum of distance between the bank and all other companies in the network. So this measure is a proxy of the speed of information transmission. So how fast information reaches the bank. And finally, we consider the betweenness measure. So this is a measure which takes into account the sum of the number of parts that passes through the bank for connecting two companies in the network. Or in other words, it captures what is the importance of the bank in the network for flow of information. So based on the literature, we also control for other bank characteristics. So this basically gives us a hypothetical network of 3 banks and 2 firms. So just to give an idea about, so here bank R in this hypothetical example is an unconnected bank and will have no direct connection, no indirect connection. So basically a 0 measure for the centrality measures. Then a bank like Bank P is actually a bank that is directly connected to more number of firms. And at the same time, it will also have a high betweenness measure, because if you just see here, this bank is very important for connecting Bank Q to say Bank T, or say Bank Q to Bank X, or even Bank Q to firm X. So this is how, so in this hypothetical example, Bank P has both higher degree as well as betweenness. But in real world networks, it could be a bank can be having a high degree, but could have moderate betweenness measure, or vice versa. So this is the summary of network measures by bank type. So the average for the private and public sector bank. So the key takeaway here is again similar to what I was mentioning, So here, suppose we can see that when we look at the direct connections, on an average, it seems that the public sector banks have higher number of direct connections compared to private banks. But for, say, another measure like the indirect connection or how well connected are the connections of the bank, we see that the average for the private banks is higher than the public sector bank. So doing well in one of the measure may not really imply that the other measure will also be high. And hence it is kind of desirable that each of the measures are considered separately. So this is the main specification. So we basically in our empirical framework consider stability as a function of both network and bank type and other bank characteristics. However, given the fact that both network could be possibly endogenous, so what we do is we use an instrumental variable method. So what is the instrument that we use for the main results? So we consider both sides as an instrument. So both sides has been used as an instrument by Abdelbade and Salama in their 2019 paper in the context of US. Secondly, in the Indian context, Sarkar and Sarkar 2018 actually found in their paper that both sides is not related to bank outcomes, again, giving some credibility for using this as an instrument. However, later we also relax the assumption that the instrument is exogenous, and also we use an additional instrument that we will be discussing later. So very quickly coming to the main results. So the first result is related to the asset quality measures. So both for GNPA and NNPA measures, we find that all our centrality measures are negatively related to the outcomes, or in other words, higher the centrality measure. On an average, better is the financial stability as given by the asset quality measure. What is also worth noting here is we find that the closeness measure, which basically captures how fast the information reaches the bank, is of a lot of importance, along with the quantity of information. Also, I would like to point here that these like the effects are actually that we find in our paper are much more modest compared to the Abdelbade and Salama paper in the context of US. So one possible reason there could be is something that has been highlighted by the Nayak committee report of
sorry for interrupting. You have 5 more minutes.
Okay, sure. So Nayak committee report 2014 actually talks about the fact that for most of the bank board meetings, most of the time is spent on financial reporting related issue, and very less number of risk related issues are actually discussed. The results for the Z-score as well as the volatility of ROA are also similar. So again, we find that the speed of information transmission is very, very critical in the network. Then we conduct a set of robustness tests. So first, we define the network measures using the director level information rather than the bank level information. We also use an additional instrument, which is the number of firms headquartered in the same city, and results remain qualitatively similar. We also relax the assumption that the instrument is exogenous, and we again find that the results pass with a range of relaxation of this particular assumption. Next, we ask the question whether this improvement in financial stability is at the cost of performance or not. And what we find is that a larger network is actually related to, on an average, higher accounting performance given by return on equity and return on asset. Then we also looked at the heterogeneous effect by interacting the network measures with the ownership dummy, so private dummy. And we find that most of the results are driven by private banks. So what could be the possible reason here? So Sarkar and Sarkar 2018 in their paper find that directors on PSBs are actually appointed very close to their retirement, and hence they have lower tenure. So these directors may be less concerned about career advancement and can be less involved in the operational issues of the bank. Additionally, Acharya and Rajan 2020 also point towards the fact that appointment of directors when it comes to public sector banks is not very transparent and their operational independence is also low. Additionally, in our sample for the 2019 year alone, we find that for public sector bank, less than 50% of the directors had a degree which was relevant, like related to finance and management, which was much higher at close to 64% for private banks. Then we examine what could be the possible channel that are driving our results. So first is we look at monitoring of borrowers as a possible channel. And here we consider the number of firms where the director is also, so number of firms which are borrowers where the bank is also appointing its director. And then we find that a large network is positively related to sitting on the board of its borrower, and that possibly could indicate better monitoring of borrowers, which in turn actually improves financial stability. Second, we try to examine whether access to soft information is another possible channel driving our result. And here the outcome is the number of loans restructured at the bank level. And we believe that resources or expertise of the director could be important here. And again, we find a positive association in this context. So coming to the summary of results. So what we find is that well-connected bank board helps to improve the financial stability. And this is not at the cost of poor performance of bank, indicating that possibly the integrated resource dependence view of the board is at work. And this is further strengthened when we find that access to soft information and better monitoring of borrowers are the possible reasons that drive the result. Finally, we also find that the results are driven by private banks. So what are the implications of this study? So first, we believe that restricting the number of directorship held by bank directors, especially for the set of banks, may not be really beneficial. And also from investment perspective, so possibly investing in bank stocks with large board network could also lower the exposure to systematic risk for investors. Thank you.
Rajendra, are you there? Okay, I don't know if he's there.
Yeah. Hello, I'm there.
Okay, perfect. Yeah.
Yeah. So thank you, Shreya, for a excellent presentation. So Ashima had a question. Do your controls include type of lending? Private banks largely made retail loans while PSBs were lending to infrastructure firms. Also, do you check for strengthening in PCB boards over time?
Okay, so in our framework, we do not control for the type of lending. So at the bank level, what is the kind of like firms or whether their loan portfolio is concentrated in a particular sector or particular types of firms. So this is something that we haven't looked at. Strengthening in PCB board over time. Okay, so no, so we have these bank type and then we have the year fixed effects, not type over time. So this is something that we can look at. Okay.
But can it be said that the bank boards have been strengthened over time, or can
So first of all, like what do we mean by strengthening is something that we have to first, so when we are saying strengthening, is it like the type of director or is it the composition of the board, like share of independent directors? So those things have we have control, but not for a type of bank, whether over time their board structure has changed more than say the private banks. So that is something we haven't checked.
You have another question that has come. What is the frequency of your data when you are calculating volatility of ROA? Also, you have about 340 observations. Is this good enough to do network analysis?
Okay, so yeah, the first part is the frequency of data. So frequency of data for our analysis is annual, but the volatility of ROE is based on the last 5 years volatility. So financial information is available for the banks every year. For 340 observations, so these are bank year observation. Our network analysis is not based on 340, but the network is based on all like the connection of the bank with all public as well as private firms for a given year. So the measures like the interest variable is not based on the 340 observations.
Rajendra? Okay, so let me just go ahead and ask you, Shreya, in case.
Yeah.
So there's a question: how board connectedness improves bank stability? Does better governance involve different credit standard towards loan recovery? Just trying to understand how NPA gets reduced due to board connectedness.
Okay. Okay. Yeah. So that's what we were trying to examine when we were trying to see that. See, one possibility could be that when a particular bank has a well-connected board, that is, they have and they place few of their directors on the boards of their borrowers. And literature talks about that often the bank directors kind of are better monitors, so they can monitor the borrower better, which in turn can reduce the non-performing assets for the bank. And similarly, another strand of literature talks about that these bank-appointed directors provide financial expertise to the borrowers, that in turn again can improve the performance of the borrower, which again in some sense is good for the bank, because that kind of ensures that they are able to repay the loan at in a timely manner, and hence that should show up in terms of the financial stability measures.
But from your data itself, just following up on this question, there is no way that you can establish that because there is better connectedness amongst the board members, there is an improvement in the credit standard or the lending standard of the bank, right?
Right. We cannot assess that. So what we do in an indirect manner is we basically try to see that whether these banks are more likely to appoint their directors on the board of borrowers. And then we use the finding in the literature to indirectly argue that this is possibly what is happening, but we cannot really observe what you are mentioning.
So generally there is found persistence in the bank level stability measures. Did you not apply the dynamic panel GMM to take care of these lags?
Right. So so we did check for this, but one of the concern was, since we had a small sample, as in if you look at the bank from years, so when we use the dynamic GMM, we also lose more information. But we did check for this, and the results were similar, and hence we didn't go forward with that. So we wanted to stick to this particular, but we did check in the initial, So in the current form of the paper, this is not there as well.
Yeah, okay. Can you look at the board network connections from the perspective of gender diversity literature?
Right. But here, okay. So basically two things. First, here, when we are trying to test for the resource dependence theory, so we do not really believe that there could be directly a role of gender diversity to access to resources. And secondly, since our period of analysis also 2009 to 2019, so before the Companies Act, the recent Companies Act, basically few of the institutions, so banks may not even have a woman on board. So that's why we didn't want to bring in that angle as a part of this analysis.
Isn't the idea of putting a cap on number of directorships to ensure that directors are not overstretched and do justice to their commitments? You seem to suggest that directors monitor loans or recommend loans given by the bank. Is this the role of a director? This is Professor Chandrasekhar.
Right. Right. So what we are saying, we are not saying that directors directly monitor the loans, but literature talks about the fact that when the bank appoints a director on the board of the borrower, their objective is to kind of ensure that the risk-taking appetite of the borrower is like modest in the sense so that they can repay the loan. So that's the idea behind placing the director on the borrower's board. And that's the channel that we are talking about. So directors are not directly related to like whom to lend and why to lend. But once the lending decision has been made, whether to monitor the borrower or not, or to provide financial expertise to the borrower.
Could it be possible that the banks with better board connectivity have board members who happen to be on board of stable firms? Given fit and proper criteria for bank board members, it might be true, and the bank lending to these stable firms, and the bank is lending to these stable firms. This is just a comment. I mean, I'm just reading out. I can't see that clearly.
No, but Rajendra, I think that's actually a very important question in the sense that there is this other conduit through which you're getting the result. So basically, the bank is lending to a kind of firm which itself is stable, and that is why you're getting the result that you're getting. It may not really be a function of the connectivity of the board per se. So there is this identification problem, which I don't know whether you're able to explain in your analysis, that the result is driven by something else that you're not controlling for in your analysis.
Right. So I understand. So you're talking about the stability of the borrowers. So what if the borrowers were ex ante more stable, and hence these banks are also like the good banks? Yeah.
Exactly.
Right. I get that point. So yeah. So this is something that we have to like think through how to account for this from the borrower. So the problem here is that we do know that whether a particular bank has borrowed to a firm or not, but for the firm, we exactly do not know what proportion of its borrowing comes from a particular bank. So
Okay, so we have now we are time for this session is over. I would just like to request everybody to put on their videos so that we can have a photograph at the end of the session, and the session is now coming to an end. So please start your video, everybody. There's a request for everybody to start their videos. Well, okay. Okay, thank you. Thank you, everybody, for a wonderful session. We had wonderful presentations and great discussion. Thank you.
Hi everyone, just an announcement. So we have about a half an hour break now, and we will reconvene at 6:30 p.m. sharp to start the highlight of the day, which is the keynote speech by Professor Ugo Panizza. So please, everybody, take a break now for half an hour, but please be back by 6:30 sharp to attend that excellent session that we're all looking forward to. Thank you so much. Hello, everybody. Welcome back after the break to a much awaited keynote speech by Professor Ugo Panizza. For that, I would like to invite Professor Partha Chatterjee, who is head of the Department of Economics and Professor of Economics at Shivnadar University, Delhi. Partha, the stage is over to you. Thank you so much.
Thank you, Rajeshri, and thank you for inviting me to be, part of this conference. It's always a nice feeling to be part of anything IGIDA does. And today, of course, I'm really glad to invite Professor Ugo Panizza for a keynote speech. But before he takes over, and I'm sure all of you are waiting for that, let me introduce him and tell you a little bit about his work, right? So Professor Ugo Panizza is a professor of economics and a Pictet chair in finance and development at the Graduate Institute of International and Development Studies. He is also the director of the International Center for Monetary and Banking Studies, editor-in-chief of International Development Policy, and deputy director of the Center for Finance and Development. He is a vice president and fellow of CEPR, fellow of the Fundación Inuadi. Before joining the Graduate Institute, he was the chief of the Debt and Finance Analysis Unit at the United Nations Conference on Trade and Development, and a senior economist at Inter-American Development Bank. He also worked at the World Bank and taught at the American University of Beirut and the University of Torino. So he, of course, has huge experience in not only at academia, but also at multilateral institutions, and has done substantial work on sovereign debt and default, crisis, international finance, banking, and economic growth. He's also focused his attention on studying Latin America, Middle East, and of course, his home country, Italy. Today, Professor Panizza will give a keynote address on rethinking sovereign debt. There couldn't have been a better person than him to talk about sovereign debt and sovereign default, a topic that is of critical interest in today's world, where during the pandemic, sovereign debt has gone up practically in all countries. That with the fact that economic recovery is still fragile, and even without saying Omicron, the threat of the pandemic still lingers on. So the risk of sovereign default in certain countries also is real. There's several aspects of sovereign debt, from the origin, determinant, composition, denomination, tenure, how markets view sovereign debt, and so on. There's also the question of impact of sovereign debt on a variety of dimensions, on growth, of course, on inflation, as we are talking about today, on exports, and again, a whole list of those macro variables. Then, of course, there is this political economy of sovereign debt, relationship between nations and multilateral institutions, negotiations, renegotiations. Professor Panizza has explored it all. He has written numerous papers, books, edited volumes on all these aspects and more. Not only has he assembled and worked on several data sets, but recently he has done some fantastic work using archival material and interviewing people who were in the thick of dealing with the sovereign debt and default. In today's talk, which I'm sure will be very engaging and exciting, he'll cover a wide range of these topics. With this, let me hand it over to Professor Panizza.
Thank you very much for this very generous introduction, also for inviting me. It's a great pleasure and an honor to be here. I'm just a bit jealous. I was looking before we starting at this slideshow with all photos of past conference and so many friends who actually managed to go to the conference in person in Mumbai, and I would have loved to do that. But hopefully it will happen in the future. So thanks again for the invitation. I'm gonna try to share my slides now. This something, some disaster always happens at this point, but let's see if it works. Share. Okay, I assume you're seeing the slides at this point.
Yes, we can see that.
Okay, excellent. So as Partha said, I will be talking about rethinking sovereign debt, and I split this talk into 5 parts. I want to spend a few minutes talking about facts, and then I would like to say something about what I call the different types of sin. So I will talk about the idea of original sin in international finance, and then discuss about the implications of these facts for research on sovereign debt. And I will come out with some radical ideas. So let's see how they go. And then say something about how we could prepare. So as it was mentioned, levels of debt, and I will show you some graphs, increased dramatically already before the COVID, but then with the COVID crisis, they increased dramatically worldwide. If you look at the debt sustainability analysis for low-income countries, which the World Bank and the IMF do every year, about 6 or 7 years ago, only about 20% of countries in the world were classified as being at high risk of debt distress. Now more than half of low-income countries are classified as being at high risk of debt distress. So you know that about 80 countries have been applying for IMF support recently. So hopefully disaster will not happen, but it's good to be ready for it. And I will say something about my thinking about this, which is mostly based on work with Mito Gulati, who is originally from India, and with Patrick Bolton, and then I will conclude. So let me start with the facts. So this is like you've seen graph of this type. So there are many lines here. So let me just focus on 2 lines for each side of the graph. Well, first of all, here we have advanced economies, and here emerging and developing economies. And the 2 lines I would like to focus on are the black solid line. So this line, which is the simple average of the debt to GDP ratio for all advanced economies. And the same here, we have it for all emerging and developing economies. And this dashed line, which is a weighted average, weighted by GDP. So you see 2 things here. First of all, in advanced economies, debt ratios were decreasing. They started increasing in the aftermath of the global financial crisis. They increased very rapidly, and then they increased very rapidly. They were sort of stabilizing, and they started increasing very rapidly because of COVID. One thing that is clear by comparing the solid line with the dashed line is that debt levels in large countries are much higher than in the average country. So here is an average for which the countries like Japan and the US, but also Germany and my own country in Italy get higher weight than smaller countries. And you see here that the difference is very, very large. This is partly driven by Japan, but it's not just Japan. In emerging and developing economies, you see that there was a decrease in debt ratios until the mid-90s. Again, an increase up until around 2000, a decrease again, and then, you know, debt ratios started going up again in the aftermath of the global financial crisis. So there was more an up and down trend, but debt ratios now are lower than what they used to be 30 years ago. And in this case, we see no difference between the simple average and the weighted average. So we see that these two lines are about the same. So no difference here between larger emerging and developing countries such as India or China and smaller emerging and developing countries. So that's just one fact about total debt levels. One interesting element that was mentioned before is about the composition of debt, and one interesting thing is looking how public debt is, you know, the composition between domestic and external debt. And here, these graphs, they just focus on emerging and developing countries. So this graph has all emerging and developing countries. This one are upper middle income, lower middle income, and this is low income. And again, the two graphs I would like to look at are the solid black line, which shows a decrease in the share of external debt over total public debt in the typical emerging and developing countries, a decrease which was not very pronounced from about 75%, so 3/4 of public debt used to be external, to about 65%, so decrease, but not a huge decrease. However, if we focus on the weighted average, so again, a case in which countries like India is a typical country which has almost no external public debt, and China, we see a much more rapid decrease, with only about 20% of the stock of public debt being owed to external creditors. We see the same thing. We focus on upper middle income countries or lower middle income countries, while there is no difference basically between large and smaller countries if we just focus on low income emerging market countries. So two things. If we focus on emerging and developing country, number one, debt ratios have been going up with no difference between larger and smaller countries. And the share of domestic debt over total public debt has been increasing. And that's especially the case in the largest emerging economies. And I mentioned India and China, but that's also the case in countries like Brazil, for instance. Now, there is a big caveat with this data, because most countries do a very poor job at publishing statistics on the composition of their public debt. So this is something that I always found a bit puzzling, because, if I ask you, tell me what is the GDP of country X in 1970, you will come out with a number. Maybe the number will not be precise, but you can Google and tell me pretty much the GDP of every country in the world in 1970. If I ask you what was the debt to GDP ratio of many emerging market countries in 1970, you will not find a number. And if I ask you what was the share of external debt, you will not find a number either. And and this is, I always found this puzzling, because when you think about GDP is an incredibly complicated statistics. In theory, measures everything that happens in a country, while that should be, there a relatively small number of transactions. They're all administered by a relatively small number of agencies, so it should be easier to have data on debt, data on GDP, but still data on debt are very hard to come by. But what I wanted to say is that these graphs are based from the IMF and World Bank international debt statistics. Now there are two researchers at the IMF who tried to improve this data for a small set of emerging market countries. And so these two researchers are called Arsenal and Tsuda. And when we look at the Arsenal and Tsuda data set, we find numbers which are completely different. So for instance, one thing that is interesting when we look at external debt is to know how much of this debt is denominated in domestic currency vis-a-vis dollars. If I take the World Bank international debt statistics, which is what I used to do these graphs, I get that only about 3%, with a very small increase over time of this debt is denominated in domestic currency. If I get this data, which have been compiled for a very small number of countries by Arsenal and Tsuda, and they're only available from 2004, I find two things. Number one, a much larger share of domestic currency debt, external debt now, about 40%, and a very large increase over time. So we are still in a world in which most research is done using this data, but these data don't seem to be capturing very well what is out there. And if you want, in the Q&A, we can discuss why that's the case. So, but taking the data as they are, there is a larger share of domestic public debt and likely in domestic currency, and there are some good things about it. We know there is research by several authors showing that risk spreads in local currency are less sensitive to external factors. Currency mismatches are less important, so it's less. We risk less of being in a situation in which the debt to GDP ratio increases because the currency has moved, and there could be potential positive spillovers of having a well-working domestic debt market for corporates who want to issue domestically. There are also vulnerabilities. Sometimes domestic debt is more expensive and is a shorter maturity. Having a lot of domestic debt can have issues related to monetary credibility. There is a positive market creating effect, but there could also be crowding out. And then I'm European, I'm Italian, and I know very well the problem of the diabolic loop in which sovereign risk is transferred to the banking system, which then fits back into sovereign risk. So let me just say something about, as I said, different types of sins. I saw that in the picture that you showed at the beginning, there was Barry Eichengreen. So with Barry Eichengreen and Ricardo Hausmann, nearly 20 years ago, we launched this research agenda on original sin, and the key idea was of original sin was that when countries borrow abroad, they tend to do so in foreign currency, and this leads to currency mismatches, which I mentioned before. So given that most of a country's income given the tax revenues tend to be denominated in domestic currency, most of GDP is linked to the domestic currency, unless you're a country which exports a lot of raw materials. When the currency depreciates, and if you have a lot of debt in foreign currency, the debt to GDP ratio jumps up. Currency depreciation could be contractionary. The fact that currency depreciation could be contractionary and could have negative effect on debt sustainability, countries end up having limited ability to conducting an independent monetary policy. And we also show that this leads to lower credit rating for any given debt level. The responses that we had put forward at that point was, well, if ideally you would like to graduate from original sin, but if you cannot, then foreign currency borrowing, external borrowing must just be, could be just too dangerous, or just you either don't borrow abroad or you don't borrow in net terms. That is, you let the private sector borrow abroad, and then the official sector compensates by accumulating reserves. More recently, Agustin Karsten and Yun Shin at the BIS put forward the idea of original sin redux. And this idea is really based on this graph, which I showed you, that some countries seem to be able to graduate from original sin because now they're able to borrow abroad in their own currency. But Karsten and Shin point out that this leads to another problem, because investors seem to be willing to lend to these countries in the country's currency, but they're very nervous about it. And so they keep a look on the country, and as soon as they get a bit worried, they take the money out. And so this leads to other problems. In sense, it leads to problem of very high capital flow volatility, which can lead to crisis. So countries are a little bit between a rock and a hard place, because when we're thinking about the traditional original sin, we're focusing on balance sheet effect, which is a stock problem. So you have a debt denominated in foreign currency. When the exchange rate moves, your debt to GDP ratio goes up. And the key policy implication was to try to borrow abroad in domestic currency. Now we see that some countries manage to do this, but according to Karsten and Shin, this does not solve the problem, because now we no longer have a stock problem, but we have a flow problem, in the sense that, again, investors are very nervous, are very jittery, and as soon as they are worried about a movement in the exchange rate, they just take the money out and make this worry self-fulfilling. So here the policy implications are even stronger, in the sense they are, don't borrow abroad, which is challenging if a country has some sort of saving gap and wants to invest more than what it saves. So that's a little bit about facts about the current situation. Now let me go to the more, let's say, heretical part of the talk. And I will start by giving a trivialized summary. And again, it's a trivialized summary, but it's not fully wrong, of the theory of sovereign debt in emerging and developing countries. So the theory of sovereign debt in emerging and developing countries is rooted in a seminal paper by Eaton and Gersowitz. And in the Eaton and Gersowitz paper, there is a benevolent social planner who cannot commit to repay because of sovereign immunity. And since he cannot commit to repay, lending to this country, to this sovereign, is risky, because the sovereign could decide not to repay at any moment. And this limits the sovereign's ability to borrow. So one of the messages of this literature, if only the social planner could commit, the social planner could borrow more, and welfare would be improved. Now, in this model, what makes sovereign debt possible, what generates willingness to repay, are the cost of defaults. So the idea is that I cannot force the sovereign to repay. The sovereign will repay only if the sovereign thinks that defaulting is more costly than repaying. And clearly lenders will anticipate this and will be willing to lend only if they think that the cost of defaults are high enough so that they create incentive to repay. And on the basis of this idea, there's been a lot of theoretical and empirical work aimed at assessing what these costs of default are. And in the original paper of Eaton and Gersowitz, the key cost of default was reputation. So the idea was that if I lend to you and you don't repay, nobody will ever lend to you again. And this idea of reputation was criticized by many authors, but is still present in the basic framework. Now, while originally the cost of default focused on reputation, there were some theoretical criticisms to this, but the most striking criticism when we're trying to build a quantitative model of sovereign debt, in this quantitative model, reputation doesn't really matter. So basically, it does not affect the willingness to repay in any meaningful way. I will show you in a moment some numbers. So that's sort of the theory of sovereign debt in emerging and developing countries. In advanced economies, again, with a bit of trivialization, we don't have a social planner. We have self-interested politicians who borrow too much. So again, in emerging and developing economies, we have this social planner which would like to commit but cannot commit, so it cannot borrow enough. And here we have the opposite problem. We have these guys who just care about themselves and they borrow too much. Until recently, there was no risk, since in the more recent paper, risk has been included. And most of the discussion here was how we create budgetary institution and fiscal rules that limit temptation to borrow. So there is really kind of a dichotomy in the way which think about sovereign debt in developing and in advanced economies. So why? Well, one key driver of this difference was that there was this idea that emerging and developing economies mostly borrow abroad, and this is what creates this incentive to default, because after all, if I default, I will not be transferring resources to foreigners, which are not my voters. So the countries could, if there were no cost to defaults, in theory the country would be richer because I'm not transferring these resources to foreigners. And while this is not an issue in advanced economies, which are deemed to borrow mostly domestic, as we have seen, this view, even if it made sense 40 years ago, it doesn't make much sense now when most public debt in many developing and emerging market economies are borrowing a substantial amount domestically, and at the same time we have advanced economies like the US, which have a very large amount of external debt. Also, there was no risk in the typical advanced economy model, because until Greece, we didn't have any default, at least after World War II in an advanced country. So as I said, there are issues with the typical Eaton and Gersowitz model. And one issue is that when you try to put numbers in this model, do a quantitative version of the theoretical model, you find that you are greatly under-predicting actual borrowing. So it's hard to explain actual borrowing patterns with this model. And the other issue is that reputation, that is exclusion for future borrowing, it's almost irrelevant in quantitative model. These are some numbers from a calibrated model from the textbook of Uribe and Schmidt-Grohe. And it basically shows you, if you have a model in which defaults as an output cost, but we have no good theory for the output cost. We put it there because that's the only way to make the model work a little bit. The country can sustain about an external debt of about 15% of GDP. You see that it's a very small number, even putting both reputation and output cost. If we remove reputation, the number goes down to 13%. So at most, reputation can explain 1.5% of GDP in terms of debt. But in fact, if we put reputation only, the sustainable level of debt goes down to 0. So reputation doesn't seem to matter in quantitative models. But Partha mentioned that we interviewed a lot of people for this paper, which I'll mention in a moment. If you talk with policymakers, that's the only thing they think about. They only think about reputation. So here, there is a lot of econometric work. I will not show you econometric work. I will show you some newspaper. So before Greece, Argentina had the largest default in history, and a default which resolution went on for nearly 15 years. And just a few years after it resolved this massive default of $100 billion, it issued a 100-year bond. Like, tell me that there is a reputational effect if, like, 3 years after you solve the largest default, you issue a 100-year bond. And of course, Argentina, 2 years after issuing this bond, it defaulted again. And Greece. So after Argentina, the largest default become Greece, right? So Greece is borrowing at negative interest rates. You want another example? So, this is November 23, 2020. Zambia becomes the first coronavirus era default. What happens now? August 30, 2020, not even 12 months after. Zambia debt in record demand. So it's hard to think that there are these long-lived reputational effects. It's not just the econometrics, it's not just the quantitative models, but anyway. So other problems with this model that they don't do a good job at matching spreads with default probability. When you see defaults, they always tend to happen at the same time. So, we need a theory which puts more weight on external finance shock. And the other thing that, to me, by looking at the data, the difference between emerging and advanced economies is becoming smaller and smaller. So maybe we should think about a unified theory. And more in general, all the theory of sovereign debt in emerging market country builds around this concept of limited commitment, which is linked to the idea of sovereign immunity, to the fact that you cannot force countries to pay. But is this the most important issue in the real world? And I'm convinced it's not. So now I'm going to tell you quickly a personal story, then I'll wind up because I think I can have 5 more minutes, right?
Yeah, you have about 10 more minutes actually.
So. Oh, 10 more minutes. Okay, I'm good. So I'm going to tell you a personal story. In 2013, the IMF published a policy paper. So this is not one of these papers which is signed by somebody and has this disclaimer, these are the opinion of the author, not the opinion of the IMF. This was a policy paper of the IMF. I could tell you who authored that paper, but I'm not going to say it. I mean, it is in the footnote, you'll see him. Yeah, it's, anyway, I will not say anything at this point. Anyway, so in this paper, in the first page said that restructuring have often been too little and too late. So this has become official IMF policies around 2013, which is a massive deviation from the standard view that the problem is that countries have this commitment problem and they default too often. In fact, exactly 7 years before this, in 2006, I had written something similar in a report in the international organization in which I was working at the time, together with a colleague. And we were called to the office of the vice president of this international organization, and we almost got fired for saying something like this. So in 7 years, this went from almost theoretical statement in which we risk to be fired to being the first page of an official document of the IMF. So that's the first thing. It's like we still have this theory which is built with the idea that countries like to default but this doesn't seem to be in the real world. There is also the issue that is not clear what a default is. So there is a nice new paper by Josephine Myers, Christoph Trebesch, and Carmen Reinhardt, which strongly is called Sovereign Bonds since Waterloo, which strongly make this point that default is not a 1-0 event. There is sort of a continuous, almost continuous definition of default. And Partha mentioned before that we did this paper looking at archives. So this is the paper that he was mentioning that he kindly invited us to present at his institution, which is a case study of Colombia in the 1980s. Colombia is an interesting country because it's a country which is deemed as not having defaulted in the 1980s. The only Latin American country that didn't default in the 1980s. But actually, Colombia defaulted, just it did in a different way. So here is the heretical slide. And so what about thinking about rebuilding the theory of sovereign debt? By instead of assuming that country don't want to pay and only pay because there is a cost of default, by assuming the exact opposite. That countries want to repay, but sometimes are unable to do so. And by the way, that's what you get when you talk with policymakers. You know, you never find a policymaker that says, like, oh, if only I could default. These guys, they always want to repay. Maybe because of their own personal reputation, not the reputation of the country, or whatever. But, you know, people want to repay. And this seems rooted in the Eaton and Gersowitz tradition, because the standard answer that you get to this is like, country can always repay. So they tell you, Greece, it could have repaid, could have sold the Parthenon, could have sold Santorini or whatever, which, well, it's trivially true, but it might be we put limits to what we can do to repay, right? We think that maybe territorial integrity is, we don't break this, or we don't sell national treasures. So even if this view seems almost heretical, it looks to me a better representation of reality. Modeling it, it's difficult, but there is a nice paper by Fabrice Collard, Michel Habib, and Jean-Charles Rocher, which is a step in this direction, and we're working together to see if we can extend this. So in a sense, maybe this is a crazy idea, but I love this quote of Niels Bohr, which once said, you know, your theory is crazy. We just don't know whether it's crazy enough to have a chance of being right. So let me just use my last few minutes to briefly mention something about our thinking about what we should do if a disaster happens. So what if in the next few years we have a wave of sovereign defaults? What if we have like 10, 15, 20 countries defaulting at the same time, like it happened in the 1980s? It's going to be the same mess. So if you remember the 1980s, it took more than 10 years to resolve all this debt crisis. In Latin America, they came out with this expression, the lost decade. Is it going to be like the 1990s all over again? There are similarities, but there are also differences. First, there is a different debt structure. Now, most debt takes the form of bonds instead of bank loans. There are good and bad things here. With bonds, you have more of free rider issuer. You have more people who need to be convinced to restructure the debt. But it might be easier because one reason for which the banks didn't want to restructure their loans is because all these loans were booked in their books at face value. With investors who care more about mark-to-market, maybe it's easier to restructure. There is a wider and more diverse set of official players, mostly China, which is an important lender, but also other countries. So that's another difference, which might make the things more complicated. One thing which is common is that we still don't have a system for dealing with sovereign default. So we still don't have a bankruptcy court for sovereigns, or what the IMF had proposed on FDRM. Some people think that this is good. Some people think it's bad. I think it's bad, but there are also reasons to think this is good, and we can discuss this later. So we have a paper with Patrick Bolton and Mito Gulati, in which we have a series of proposals to provide what we call legal air cover to kind of allow country to negotiate if many defaults happen at the same time without the risk of being all sued at the same time. So we discussed this in this paper, thinking about some techniques which had been used to deal with the restructuring of the Iraqi debt after the fall of Saddam Hussein. So let me just conclude at this point. So over the last 20 years, that structure has changed. And I think the extra theory needs to catch up with this. There are new vulnerabilities and new sources of resiliency linked to this new debt structure, but the international financial architecture is still lacking. And one thing that worries me, that if we were to have a disaster, like many countries defaulting at the same time, we would not be well equipped to deal with this problem. I should say that some people agree with me on this, but I have many friends for whom I have an enormous respect who disagree on this latter point. So this is really something which I think it should be discussed, but there is no consensus on that. So I will close here, and I'll thank you again, and maybe I'll stop sharing.
Thank you so much, Hugo, for that very interesting talk. I will now, there's certain questions that has been written on the chat box. I will just read out some of them for you, and I think I'll try and see if I can club few of them, particularly Venkatesh Hari. He has two different questions on the original sin redux. I think what he is interested in is finding out a little bit more on your views about short-term policy measures that could limit that original sin redux problem in EDs.
So this, I mean, this is really something you should invite Yoon and Agustin, because they are really the fathers of this. My understanding from reading their papers, that in a sense their view is even more pessimistic in a sense that ours when we're writing about original sin, because when Barry, Ricard, and I were writing about original sin, we say there is this problem. If we could devise a set of policy which allows countries to borrow abroad in their own currency, then this problem would go away. Now, my understanding is that the view of Carstens and Shin is more pessimistic in a sense that say, even if countries manage to borrow abroad in their own currency, investors will remain very jittery, and this will lead to volatility. So at the end, what you really need to do is to develop very large domestic markets, and only once you have these very large domestic markets, you'll be safe from these issues. That's my understanding, but I wouldn't want to to provide an interpretation of their thinking, but that's my understanding from reading the various papers by Yoon and Agustin Carstens.
Right. The next question is from Ashima Goel, and I think it's very important and interesting question, particularly in the context of India, as you mentioned, has very little debt denominated in US dollars and so on, right? So, so what she's asking is that foreign investors you mentioned in domestic currencies are skittish. Are all types equally so? Does listing in the EM bond market indices lead to more stable fixed income flows?
So this is, well, let me start by saying that I don't know the answer, but this is interesting because I was discussing exactly this question this morning with a student who got some data on allocation by passive versus actively managed funds. And what she really tries to would like to understand, and she hasn't started, so we're discussing her PhD thesis proposal, but what she would like to understand is exactly this, in the sense, her question is really, do passively managed funds amplify volatility, which I think is an interesting question. So I don't know the answer to this. So clearly, people have been writing for a very long time the different type of flows of different types of volatility, right? So in the sense that FDIs are more stable than than portfolio flows that we have known. We also know that the different type of lenders, like official versus market lenders, are different cyclical properties. So I have a paper with Arturo Galindo that shows that official lending tend to be either counter-cyclical or cyclical, while private sector lending tend to be more pro-cyclical. But haven't seen a paper who differentiates among types of private investors. That doesn't mean that the paper doesn't exist, because but I just think it's interesting, because I was discussing this exactly this morning with a student.
Sure, thank you. Thank you. Rajeshwari Sengupta has a couple of questions and kind of leads from where you stopped right now, which is to say that, are foreign investors potentially hesitant to invest in EM currency debt because lack of hedging options, right? So, and then she continues to say that one fallout of EM governments borrowing in domestic currency is that they often use captive markets for issuing bonds. This leads to massive financial repressions, right? So we see this a lot in India, and especially now during the pandemic, when the debt is close to 90% of GDP and all in domestic market. Does that reduce the cost for government per se? The implicit cost is then the bond market doesn't develop and monetary independence gets compromised again. Something we are seeing in India. What's your take on that? I guess continues to ask a question about how do existing theories of sovereign debt, default, and crisis apply in this context? Yeah.
Okay, so let me start with the hedging. So the hedging. So the issue with hedging is that who will provide the hedge? So the issue is, like, if there is somebody who provides the hedge, it needs to be somebody who's willing to go, long on the currency. So at the end, so it's true. So I might be, in a sense, if I'm willing to lend to Mexico in peso, but then I hedge the peso into the dollar, then it's as if I were lending in dollar, right? And so the next question is, like, who is the guy who's providing the hedge? If it's a domestic Mexican guy, then at the end, the currency risk hasn't left the country. I mean, there is nobody who's taking peso risk outside the country. If not, I mean, who is this person who's providing the hedge? Now, one issue is that providing these hedges might just be very expensive. So, yeah, I don't know. Probably is a bad answer, but now the other question is, in a sense, so I tried to mention something there when I was talking about the crowding out and the financial repression issue, right? So on the one hand, you need a well-working domestic government bond market to have a well-working domestic corporate bond market, and you also need it for for having a well-working banking markets, because the government bonds are the typical safe assets and this stuff. So there is a there is a big literature that basically you cannot have a well-working domestic financial sector without having some domestic public debt, which is traded, which is used, to have a benchmark curve and all this sort of stuff. The point that is being asked is that at some point when it becomes too much, this sort of market creation role of domestic public debt, it becomes crowding out, and then the next step, you need to put in financial repression, because to be able to extract resources from the financial sector, from savers. So like everything, so domestic public debt is good up to a point, up until to the point in which it doesn't crowd out private investment, and up to a point in which it doesn't require financial repression. I see financial repression as a very damaging set of policy, because it's basically taxation which is not legislated. So it's taxation which is very non-transparent, and so I mean, if you have resources, that's fine to raise resources to taxation, but this idea of rising taxes through this means, I always found it's a very distortionary thing. So yeah, so again, so I think you need some government debt, and then where you go, where it becomes financial repression, and where it becomes and where it becomes distortional, this is very much country dependent, right? It's so the US is able to issue a massive amount of domestic debt, I don't think without any particularly negative consequences for the US financial sector, or needed to require to financial repression, but it did require use financial repression in the past.
Thanks, Kumar. There's one more question in the chat box, but before I get into that question, let me ask you one question out of curiosity. You mentioned that, I mean, we know in models and in data, reputation does not really matter, right? We've seen that in the literature. But you mentioned that, many of these people that you interviewed, and we also see that playing out in the media, etc., that they think reputation matters, right? So is it the reputation of the politician that matters? Are there maybe government turnovers, domestic power struggles when countries default, and that's why they're worried about default?
So so first of all, when you talk with people, they never tell you, I'm doing this to protect my own reputation. I'm doing this to protect the reputation for the other country, right? But my impression is that private reputation matters a lot. So again, assessing causality, it's always hard, but I have this old paper where we show that Minister of Finance and central bankers tend to be replaced after defaults. Again, I don't know if it's causal or not, but at least it happens to be there. Many central banker and Minister of Finance have a life after they stop public service, and this life might be in the financial sector or might be in the international financial institutions. And I think to have this, post-service life, it's easier if you didn't default. So I do think that personal reputation is an important factor, but this is very different from, Dayton and Gersowitz model, where you have this social planner, which is,
sure.
Yeah, I do think that that's an important thing. I also think, and this, as economists, we are very uncomfortable to think like a normal person, right? But I also think for all of us in our life, day-to-day life, we just do certain things because we think that it's the right thing to do. So I think most people are hardwired that if somebody lent you money, you're supposed to give it back. So I think that's also, I understand that this deviates from, the Homo economicus model or whatever that we have. But anyway, it's a longer discussion. I mean, when I think about my life, maybe we discussed this when we were doing it. I do millions of things that I don't have that I would suffer no consequence if I didn't do them, but I just do because I think they're the right thing to do, right?
True. But okay, I have one also question about your heretic ideas, and in terms of thinking about modeling, and that a little more mundane, I suppose, in terms of that. But let's get to this question that's there on the chat box, which is about from Bhavik Parikh. And the question is, what do you think credit rating agencies can do better for potential investors in emerging sovereign debt market?
I don't know. So I was in a meeting yesterday with the UN, a UN meeting in which there was this discussion about evaluating long-term debt sustainability, right? So one issue there and one standard criticism that no mechanism for evaluating that sustainability focuses on what we have in our model, which is like the solvency condition, right? So when we write a model, we have this transversality condition, and in theory, you think that a country is solvent if it satisfies the transversality condition, but no debt sustainability methodology can be the one of the IMF or the World Bank or the one of credit rating agencies, really focuses on this concept of long-term debt sustainability, and they're all focused on a much shorter term concept, some mix between liquidity and solvency. And in that discussion, somebody said that maybe credit rating agencies should try to provide these, rating, very long-term ratings, right? Now, this is good in principle, but there are two challenges to doing this, I think. One challenge is that it's an incredibly difficult exercise, right? So again, when you think about this transversality condition, ideally you would have to project something, to the infinite, but even without projecting to the infinite, just imagine projecting something 20 years, it's, the margin of error is massive. But it's also, it would also, in a sense, be almost useless because think, in a world in which you still have liquidity crisis, and in a world in which all that is accelerated at the moment of default, right? So if I had a 100-year bond and I default on everything else, that bond becomes due tomorrow. What's the usefulness of having, a long-term credit rating if then I have a debt crisis which is driven by liquidity issues? So that was a little bit a discussion yesterday with the UN people. But maybe to answer more specifically to the question, what the credit rating are doing, I think the credit rating within their mandate, they have a methodology that they keep trying to update, and the methodology is public. Everything can always be improved, but I don't see the credit rating agency in the sovereign space. Maybe we can discuss in the non-sovereign space as the big bad guys in the thing.
Right. I think we're almost at the end of the time. So some other day, I had some thoughts on your idea about that countries will default occasionally, right? And we'll probably catch up and discuss that. And
I'd love you. We can have a Zoom coffee or tea whenever you want. Send me an email.
Well, maybe real coffee somewhere. I really look forward to that day when we can actually do that. International travel, of course, still is a little bit difficult, but hopefully soon. But thank you, Ugo, for that very interesting talk and many ideas, many questions, and I'm sure all have benefited from this today. With this, I will hand it over back to Rajeshwari. Rajeshwari, thank you.
Sorry, there was a little bit of a technical glitch. I got muted. So finally, I've been unmuted. So I want, on behalf of the organizing committee and everybody here at IGITR, I want to say a very big thank you to Professor Panizza. This was an absolutely brilliant talk, and I just wish we could go on further listening to you. I thought we were almost just getting started, but this was absolutely wonderful, and we would all love to host you at IGITR in person the moment international travel becomes safer. I think that will be an absolutely wonderful opportunity to listen to you in person. And thank you, Professor Partha, as well. Thank you so much for chairing the session. I would just request all participants to kindly switch on their videos so that we can take a photo snapshot to remember this excellent occasion. Just please switch on your videos so that we can all take a picture. Thank you so much. They will let us know once it's done. So just a few more seconds. Okay, now I've been told it's done. Thank you so much once again. So thank you, Professor Panizza. Thank you, Professor Chatterjee. So now we take a quick break.
Thank you for the invitation. It was a real pleasure, and I really hope to be able to visit you.
Yeah, that'll be wonderful. Thank you so much. We would definitely stay in touch.
Thank you. Bye.
Thank you. Thank you. So we'll take a quick break now for about 15 minutes, and then we resume the session at 7:45 for the session on monetary policy, which will be chaired by Professor Ashima Goel. Thank you. Hi everyone, welcome back.
Rajeshwari, can you hear me?
Yes, I can hear you.
Okay, good.
Yeah, you're audible. So hi everybody, welcome back after the break. We will now start the session on monetary policy, which will be chaired by Professor Ashima Goel, who's an emeritus professor at IGIDR and also a member of the Monetary Policy Committee of the Reserve Bank of India. Welcome, Professor Ashima Goel. I just have to tell you one thing. There's one paper where the presenter who was supposed to present is not able to do so because of a medical emergency. That is the second paper in the program. Ashwin Kurien is not going to be there. In his place, his co-author Bhanu Pratap will be making the presentation. Thank you so much. Over to you.
Yeah, thank you. So welcome to this session. We look forward to some very interesting papers. There are 3 papers that will be presented. We'll start with the one with authors from Rahul Rao from IIM Bangalore will present his joint paper with Professor Chetan Subramaniam, also from IIM Bangalore, and Ankit Kumar from IIM Visakhapatnam. He's going to speak on conventional versus unconventional monetary policy under financial repression. You have 20 minutes and then 10 minutes for discussion. So I will give you a warning 5 minutes before. Also, can you read the chat box yourself? So have a look at it. I'll also read out. I'll select questions. But after.
Yeah,
Okay.
I can read.
Yeah.
Thank you, Professor. Good evening, everyone. So I'm Rahul, and I'm presenting our paper, Conventional versus Unconventional Monetary Policy under Financial Repression. So let me start with the motivation of our research idea. So as we know, post-2008 global financial crisis, most of the developed nations adopted quantitative easing or large-scale asset purchases as a standard policy tool in their policy toolkit. So that was done in order to bring down long-term rates in the economy. I will come to that later. However, after the COVID pandemic hit, even the emerging economies resorted to this quantitative easing as a policy tool in order to fight the fallout to the financial sector from the crisis. So much of the academic literature has so far found these QE policies to be quite effective, that they have non-trivial effects on the real economy, and they are able to bring down the long-term rates, especially when there is not much elbow room left for the conventional policy or to cut down the short rates further. However, the literature has not really looked at the effect of these policies in the presence of financial repression. In the later slides, I will define what do I mean by financial repression. So first, let me define what is conventional and unconventional monetary policy. So central bank, through its monetary policy, is trying to manage aggregate demand by influencing the long-term rates in the economy. So it does it in 2 ways. First is conventional policy, where it cuts the short-term rates in expectation that they bring down the long-term rates in the economy to the extent that expectation hypothesis works. Second is unconventional policy route, where the central bank directly buys bonds from the bond markets, so that it creates kind of an artificial scarcity in the economy, and then their prices go up and their yields come down. And it is usually triggered when short rates are already quite low in the economy. In this paper, we are focusing on the transmission of both these economies in the presence of financial repression. So now coming to the financial repression, what do I mean by it? Lots of government policies which channelize funds to themselves, where in the absence of such policies, these funds would have gone elsewhere. That is, in a deregulated market environment, they would have gone to their appropriate owners. Now, these policies include mandated regulations by the government. For example, pension funds and domestic banks are required to purchase certain fraction of G-Secs, or there is subsidized directed lending mandated by the government for the banks. So the main goal of all such policies is to keep interest rates on government borrowing lower than it would be in a laissez-faire or in a competitive market case. Now, we put such a financial repression, I will come to it later, how do we put it in the model section. We put it in a new Keynesian DSG model, and these are our main findings. So first is, in the literature so far, they have found that if central bank purchases long-term bonds, then that brings down the term premium on both private and government long-term debt down. Whereas we find that if there is financial repression in the economy, it does bring down the long-term yields of the government bonds, but it actually increases yield on the private long-term bonds. So that basically hampers the investment, and there's the output contracts. So that is why exogenous QE in our case, it actually perverts the expected results. On the other hand, we find that the conventional policy shock or cutting down of short-term rates, it works quite fine because it reduces the private cost of borrowing. This result is actually contrary to Urjit Patel and Amartya Lahiri's 2016 paper, wherein they showed that if there is financial repression in an economy, then cutting down short-term rates is actually contractionary. In the results and model section, I will show that they actually miss out an important net worth effect due to which such a perversion will not really take place. Next, as I told you that the literature has found that QE policies are effective, and they're particularly effective when the financial conditions are adverse in the economy. For example, during the global financial crisis or during the COVID pandemic. We find that our results are contrary to literature. We find that if there is financial repression in the economy, then operating such QE policies can even worsen the conditions. However, we find that it works quite favorably. These QE policies work favorably when there are real shocks or productivity shocks in the economy. Now I will go through the model section. I will just cover the main ingredients. So this is just a schematic diagram of the new Keynesian DSG model that we have. It is a variant of Sims and Wu's JME 2020 paper. These are the main agents in the economy. So there is a representative household which sells its labor to the production firms given by L. Using its labor income, it then purchases its consumption of amount C. And then it saves its savings in the form of deposits with the financial intermediaries, which are basically banks. Then the banks have to repay gross return at the starting of next period to these households. So deposits are basically one period debt bonds. On the production side, there is this wholesale firm which gets labor from household and capital from capital goods producer, and it has to finance at least a part of this new capital purchase with the issue of fresh long-term bonds, which are then held by financial intermediaries. Then the production side is quite standard in the literature. They are unit measure of monopolistically competitive retail firms, which then repackage the produce and sell it to final goods firm, which is a perfectly competitive firm. It CA segregates them. And then the final output good is either consumed by the household, or it goes as a factor input to the capital goods producer, which then converts it into new capital, or it goes to the government for its consumption. So the government consumption is constant in our setup, and it is financed by issue of government bonds. And there is a fixed supply of those government bonds in the economy. So those government bonds are absorbed by either the banks or the central bank. For the central bank to purchase these government bonds, it has to issue reserves, which are just like deposits. So central bank, they are also one period debt bonds, and central bank has to repay gross return at the start of the next period to the intermediaries. And there is a wholesome lump sum tax from household to government, and there is central bank revenue, which also flows back to the government. That completes the setup. Now, variation from Sims and Wu is that we do not have rigid wages, which they have in their setup, although qualitatively our result will not be any different even if we include wages. Price rigidity is still there in our setup. And we do not allow the central bank to hold private bonds. And we also include our main contribution is that we add financial repression to the financial intermediaries problem. There is one important point here, that there is asset market segmentation, that the short-term market of these short-term deposit bonds and the long-term market of these long-term bonds are segmented, they are separated. In the sense that households cannot directly buy these long-term bonds from the firms, or firms cannot directly take household deposits. They have to go through an intermediary. So in this way, central bank can actually independently influence both the short-term rate and the long-term rate. So this is quite standard in the literature, but this is what actually enables quantitative easing policies to have non-trivial effects on the economy. Otherwise, all the assets will have, in expectation, will have similar returns. So going forward, I will just stick to the financial intermediaries problem. So any bank faces two types of constraints in the economy. First is leverage constraint. So basically in any economy, depositors want the banks to have a skin in their game. What I mean by this is that it should not be the case that banks are lending only depositors money to the borrowers, because then they will not have much incentives to monitor the activities of the borrowers or to rigorously risk assess them, which is actually a major role of the banks in an economy. Therefore, banks could only attract deposits proportional to their own net worth. So they have to put some of their equity on the table, and then they can go and lend to the borrowers. Now, Gertler and Karadi in their seminal JME paper, they modeled this as a moral hazard or agency problem. So at the end of each period, an intermediary gets an opportunity to divert some of its assets for its own purpose, and thus it defaults on paying depositors their whole due. Depositors can take such banks to bankruptcy and recover only a fraction of their deposits. So they will be willing to lend to banks only if the following constraint holds, where the left-hand side is the continuation value of a bank I after time t, and right-hand side is the value of assets with which it can run away. So you can see that continuation. So in our setup, banks can stochastically exit the economy with a probability of 1 minus sigma and continue with the probability or survive with the probability of sigma until they exit the economy. They keep on accumulating the net worth. So continuation value is basically expected terminal net worth. And right-hand side, so this is the QT into FIT is the private value assets with the bank, and QBT BIT is the government assets with the banks. So it can run away with theta fraction of private assets and theta into delta fraction of government assets. Delta being less than 1, it means that private assets are easier to divert than government assets. So how the leverage constraint works, so if VIT, this is our left-hand side and this is the right-hand side. If upon a shock, there is an increase in the net worth, then the VIT value goes up and the leverage constraint actually relaxes. Whereas if upon a shock, net worth comes down, then it actually tightens. Similarly, if theta t increases, which we term as credit shock, so that means that banks could potentially run away with larger fraction of assets. So that will again tighten the constraint. So in the result section, we will see that how different shocks impact this leverage constraint differently. Coming to the second constraint faced by intermediaries, it is the regulatory constraint, which is basically financial repression. We follow Shari and Kehoe's 2020 JP paper. So here, intermediaries are required to hold a certain minimum fraction of their bond assets in the form of government assets. So this is the total assets with bank I, and this is the government assets. So it boils down to this. So basically, it means that government assets have to be at least a fraction of the private assets. And when there is binding regulatory constraint, that it will mean they are both in a fixed proportion. So how the regulatory constraint changes, if this is left-hand side and right-hand side, if the central bank purchases assets from the banks, then the left-hand side will decrease. So that will tighten the regulatory constraint. Whereas if central bank sells government bonds to the intermediaries and onboards it onto their balance sheet, that will increase the left-hand side and it will relax the regulatory constraint. Similarly, if there is an increased demand of private bonds, so the right-hand side will go up and the regulatory constraint will tighten. And if there is a fall in the demand for private bonds, it will go down and regulatory constraint will loosen up. So we will see that the main economic mechanism of our model is the interplay between these two constraints and how these are being moved around by different kinds of shocks. So quickly through intermediaries problem, its balance sheet is given by it has private assets, government assets, and reserves issued by central bank, and it finances it using deposit from households and its own net worth. Second is how the net worth of an intermediary evolves. It basically earns excess returns over each of its assets, plus its own net worth grows at the rate of deposit rate. So excess return means the return it is earning over and above the cost of capital, which is the short-term deposit rate. And a return is basically your holding period return of holding government bond or private bond. So through these two equations, we can see that how conventional and unconventional policy impact net worth. So the first equation, the balance sheet equation, is how unconventional policy affects the net worth. So if central bank purchases government bonds, it means it increases reserves on the asset side of intermediaries. So that increases net worth of intermediaries. Whereas in case of conventional policy, if the central bank exogenously cuts down the short-term rate, then that increases excess returns which the banks can earn, and that increases their net worth. So intermediaries problem is to maximize its continuation value subject to both of these leverage and regulatory constraints. So Lagrangian problem, so setting the Lagrangian would look like this, where lambda it is the Lagrange multiplier for the leverage constraint, and this zeta it is the Lagrange multiplier for the regulatory constraint. Now these are the first order conditions. So these are the excess returns, lambda it, zeta it, again are the Lagrange multipliers. So now the key intuitions. So even if there is no financial, so first is, even if say there is no financial repression in the economy, that means zeta IT is equal to 0. Even then the excess returns will persist in the equilibrium as long as leverage constraints are binding or lambda IT is greater than 0. So basically binding leverage constraint then becomes the source of term premium or excess returns in equilibrium.
You have 5 minutes, Rahul.
Okay, thanks. Second, if zeta IT, so if the regulatory constraint is not binding, then we look at equation 6. And so in that case, say your return on government bonds will be RT plus 1B tilde, and this term will go to 0. Then you subtract that equation from equation 6 and we get something like this. So when we say financial repression, we mean that the borrowing rates on the government bonds, that return is lower than the laissez-faire case. So that will happen if regulatory constraint is binding, zeta IT is greater than 0. That we can clearly see from here. And next, so we can see that any change in lambda IT will reflect proportionately on both the excess returns. They both move in the same direction, whereas zeta IT puts a wedge in the excess returns for the government and private bonds. It makes the two excess returns diverge from each other. And the next one is that the reverse repo rate then becomes your policy rate. That's how you can fix the short-term rate. So central bank, this is, it's a balance sheet. The Taylor rule is very standard. It's also, your short-term rate also gets influenced by the inflation gap and output gap. Government bonds with central bank follow an exogenous AR1 process, and government bonds are total supply is fixed in the market, absorbed by either banks or central bank. So term premium is simply log difference between the log of long-term yield and short-term yield. Okay, so let me come to the results part. So first is, if there is an exogenous QE shock, it means the central bank exogenously starts purchasing the government assets. So then that will increase the regulatory constraint for the banks, because now that tightens up. But at the other hand, the reserves increase on the balance sheet of intermediaries. That improves their net worth and relaxes the leverage constraint. So the two constraints are moving in different directions. Now, because there is scarcity of government bonds in the economy, so their prices then go up, and hence the government bond yield comes down. Whereas because now you are holding lesser amount of government bonds, and to maintain a fixed proportion, you have to let go of some of the private bonds. So then that decreases their prices or increases the private bond yield. And then that has a negative effect on the investment and output, and hence the inflation and deposit rate all follows. You can see that in much of the literature, if there was no regulatory constraint, there is only leverage constraint, and which is bringing it down. So that will actually bring down both government and private yields, and the investment will then go up. So it is the regulatory constraint which is basically bringing this wedge between government and private bond yield. Second is about cutting down the short rate. So if exogenously central bank cuts the deposit rate, so then banks could earn more excess returns and their net worth goes up, the leverage constraint comes down. It is an expansionary policy shock. So there is a higher demand for private bonds. So the regulatory constraint then tightens. And in order to maintain fixed proportion, there is also then a higher demand for government bonds. So both government bond yield and private bond yield comes down, and hence the investment picks up. Now, difference with Urjit Patel and Amartya Lahiri's paper is that they did not consider the net worth effect. So they did not have this leverage constraint channel, which is actually decreasing, which is the reason for bringing down the private bond yield. They only had an increase in the regulatory constraint. Now we actually compare two policy regimes. One is a simple Taylor rule under the in the background, and another one is a term premium peg, where the central bank ensures that the term premium on government long-term bonds keep themselves at the steady state. It keeps it fixed. So it will either sell or buy the government bonds in order to peg it at the steady state level. So now credit shock means the banks can now divert a larger fraction of its assets. So that will increase the leverage constraint and bring down the net worth. Now there is lesser demand for the private bonds also. So then that will increase the private bond yield, and similarly, it will also increase the government bond yield or term premium, because they have to be maintained in the same proportion. And the regulatory constraint will go down because there is lesser demand for private bonds. So if there is now, because now this simple blue line Taylor rule, so now government bond term premium is above the steady state, and central bank wants to bring it down under the endogenous QE or term premium peg policy. So what will it do? It will start purchasing from the banks. So the government bonds with banks will go down, and hence the regulatory constraint then tightens up. So that then in fact increases the private bond yield even further. And compared to simple Taylor rule, the investment output are both lower comparatively. So in much of the literature, there was no effect on the regulatory constraint. And as you can see that if central bank purchases bonds from banks, then it puts reserves on their balance sheet. And so the leverage constraint actually soothes or relaxes. So the leverage constraint comes down. So that's why they found, much of the literature has found that during adverse financial conditions, this kind of endogenous QE policy sterilizes real economy from any financial shocks. We also corroborate this impulse response analysis with a welfare cost analysis, and we find that Taylor rule policy has a lower welfare cost associated with it than the term premium pegging policy. Last, with the productivity shock. So if there is a positive productivity shock in the economy, marginal costs come down, the prices come down, and the inflation comes down. Responding to it, central bank lowers the deposit rate, which increases the excess returns earned or net worth improves. Leverage constraint then comes down. Now there is an increase for the demand of private bonds in the economy, so their yield comes down, and the private bond yield or term premium also comes down. So now, in order to bring back the government bond term premium, central bank will actually sell government bonds to the banks, and that will relax the regulatory constraint. So then that brings down the private bond yield even further, and it has a, in fact, positive effect. So that's why we find in case of real shocks, endogenous QE policy actually works favorably. And we also, we have the same welfare cost analysis, and term premium pegging has a lower welfare cost associated with it than a simple Taylor rule. So now coming to the conclusion, this study we have calibrated currently to the standard parameter values from the literature. We are not really calibrating it to any developing economy or financial repression thing. So this is a primarily theoretical investigation that we have went into, and we'll try to add some empirical motivation to it. It's just that the private bond yield data is not that much available along with for the developing economies, which majorly do the financial repression thing. Yeah, I'm done with my presentation, and I'm
thank you.
Ready to answer.
Very clear presentation, and interesting this introducing network. And so, you know, this is why these models are like our laboratories. We have a controlled environment where we can see what is the impact. So there's a question from Chetan Ghate, who's asking, how does forward guidance work in?
So we do not have, actually right now, we do not have this incorporation mechanism in our forward guidance, because for that you will need some other setup in order to be in place. But Sims and Wood do the same kind of analysis with negative interest rate policy as well as with forward guidance. And they find like their results hold even in that kind of scenario. Yeah, so we have not done really, we have not gone into that part.
Yes, so I think that is the problem, you know, the challenge that you have.
Right.
That there are so many possible things you could put in. So how do you decide what you are focusing on? How do you justify?
So we wanted it to, like, starting with it, we just wanted to investigate, like, theoretically what is happening if we just put financial repression in this laboratory of things. So yeah, there is also like zero lower bound thing is very much there. Like all of these papers actually do that thing. So that is one of the potential future works that is there in our mind. So that we might add that particular part to it.
The other thing on your last slide is you've written that you calibrate to emerging markets. And I mean, since your model started with the Urjit and Amartya's paper, which was in the Indian context, there's financial repression and so. But, you know, the point is, I think your model really assumes a tight sort of regulatory parameter, you know, this SLR. Now, one stylized fact in India is that banks are holding excess SLR. So in that sense, it won't work in your model, right? Because they're not constrained by the regulatory parameter.
So one thing is that so we should not interpret this gamma parameter that I showed in the model as like exactly. So this is not just SLR. This is a whole bunch of policies which are there. And they all result in this kind of, because the final thing about financial repression is that the government borrowing is to be at a lower interest rate. And as I showed you that means the regulatory constraint has to bind all the times. Only then it makes sense. right? The
So
second.
what are other constraints you think hold in the Indian context?
Yeah, for example, Urjit Patel and Amartya Lahiri's paper. So they actually state a whole host of financial repression policies, subsidized direct lending, your small savings interest rates. So they all basically act in that direction. So SLR is a very pure form of financial repression, which is out there and we can see it. But all these financial repression policies.
Right. But, because, okay, there's a question from Sushanta Malik. You can see that?
Yeah. Why do we say it is financial repression when the goal is to lower term premium? A positive QE shock aims to bring down long rate down, long yield down. So first is that financial repression goal is not to really lower term premium per se. It is the final rate on the government borrowing that is there. So deposit rate might also go down along with it. So term premium need not actually be getting lowered. So that's not what financial repression is doing. It is just bringing down the long-term rate entirely. Second part is a positive QE shock aims to bring down long rate down. Long yield on public debt indeed goes down, but the yield on private bonds goes up. Such portfolio rebalancing does not occur in case of a conventional policy shock. So term premium could be higher under conventional relative to QE. Yeah, right. So this we also actually document this thing that the government bond term premium, if you just see, or the government bond yield. So in this particular example, so that actually goes up after a while. So how the shock propagates through the economy. So he's correctly saying because there is no portfolio rebalancing happening in the case of a conventional policy shock. So yeah, it indeed for the government bond term premium that goes up eventually.
Yeah, so the point is that there are many different kind of effects that work here. Now again, Rajeshwari has a question for you on your empirical implementation. You mentioned this, right? That you don't have much data.
Yeah, so because the private bond market isn't very liquid, that's the answer actually. So that's where it comes from. Although we have some like South Korea and other economies are there, but then we do not really know the financial repression extent there. Because where we are coming from in our model is not just a particular form of policy, but it is the whole bunch of policies which then can be taken together and come up with a single number on financial repression. That should be the case. In that case, how will you empirically establish?
In your model, you assume when the policy rate goes down, banks earn a larger spread and therefore their net worth, etc. goes up. But actually, loan rates also come down, deposit rates come down. So why is it necessarily that they earn a larger spread? Actually, when rates are going down,
yeah, so there are a whole bunch of things that definitely happening. We are just actually right now we have constrained ourselves to just the financial market happenings, how that is working in the economy. So the financial intermediaries problem, how that reflects.
Also, I think in one of the impulse responses, you were saying that the central bank or whatever reduces the deposit rate. That is a bank's commercial decision. Policy rate is it's just a short-term rate, and then it works through. And what happens to lending rates and deposit rates is pretty much
correct
on the bank's commercial decisions. There's another question from Arpit Kumar Parija. Does requirement for holding government bond as a fraction of total asset of the bank evaluated at fair value of bank's asset work in practice?
So it is the market value of bank's assets. So what does it mean by like fair value? I think it is the market value of bank assets which we have. Like QT and QBT both are the market prices of government and private bonds. What would happen if the fraction is based on the book value of bank's asset, not directly affected by QE?
How do you rate the monetary policy? This is a very general question. So stick to India in your answer. What is your view on what implication does your model have? Stick to your paper for understanding India's monetary policy.
Right. So this is, I think that this is like the deposit rate, as you were saying, it is an implication of our model because the model doesn't have other kind of like things. So that thing simply reduces down to a very simple thing. which is this reserve rate is equal to deposit rates. That banks really do not earn anything on the reserves.
Okay.
Yeah, which might not be actually.
Okay, Chetan Ghate has another question. How? 1 minute. Yeah, what happens at the zero lower bound versus off the zero lower bound? He likes your paper.
Yeah, so off the zero lower bound, we are already, the results that I showed, those are off the zero lower bound. We are not really hitting the zero lower bound here. And the interest rate, the channel is also very much working there. So bank, if inflation goes up, then bank responds to it by increasing the short-term rates. Yeah, right. What will happen in the zero lower bound case? That's what we are also thinking about.
Anyway, in the West, they don't have, now as debt goes up, maybe they will develop some kind of financial repression. Otherwise, they don't really have it. Raja Durai, how do you give a negative shock? Is it a mirror image of a positive shock?
Yeah, for the QE, it will be that case. It will be a mirror image.
Okay, so I think we are at time for the next paper. Thank you. Very interesting.
Yeah, thank you.
Yeah, good, clean, clear work. Yeah.
Thank you. Thank you, everyone.
The next paper is Mahapatro from the Reserve Bank of India will present his joint paper with Ashwin, Kurien, and employment researcher Sanjay Singh, the University of Houston. And the paper is on inflation persistence, monetary regimes, and credibility, a long-term perspective. Yeah, Bhanu Pratap, over to you.
Very good evening to everyone. I hope my screen is visible and
yes, we can see it. Just increase your volume slightly.
Is it better now? Hello. Is it? Am I audible?
Yes, we can hear you.
Okay. A very good evening to everyone. I would like to thank the organizers for inviting us to present our paper at this forum. Now, this is a joint work with Swati Singh, who's a PhD scholar at University of Houston, and Ashwin Kurien, who is a lead data scientist at Unilever PLC. So to begin with, the agenda for my presentation is that I'm going to talk about inflation persistence, monetary regimes, and regime credibility, and how these three things are interrelated. Then I would be diving into our empirical analysis, in which first I'm going to talk about univariate analysis, and then we would move towards a multivariate analysis. And to sort of give you a glance into what I'm going to talk about today is that this is a journey back in time. We exploit a long time series data set, which is in the case of US and UK, to derive inferences on how inflation persistence has behaved across various decades, and how this interrelates with monetary regime and its credibility. So to talk about, to begin with, what is inflation persistence? In simple parlance, inflation persistence can be defined as the inertia associated with the inflationary process. This implies that the level of inflation tends to remain constant unless and until an external economic force moves it away from that path. Now, this has important implications for the pursuit of appropriate monetary policy, and depending on how persistent inflationary process is in a given economy at a given time, the reaction of monetary policy would be in conjunction with that level of inflation persistence. The literature distinguishes between what is called a reduced form persistence. This is the empirical property of any observed inflation measure, and what is called structural persistence, which is the persistence arising from identifiable economic sources. There are three strands of literature. So to begin with, the early literature in macro used to consider inflation as a very highly persistent process.
And the way to model this in the initial macro models of the economy was by introducing a lagged value of inflation. This also produced a better fit with the data. But as we know, during the 60s and 70s, when the rational expectation revolution took over macro, inflation expectations were modeled as a forward-looking variable, which in the model sense implied that there is no persistence. However, this modeling tweak did not correspond with the persistence in the observed data. And so in various ways, macroeconomic researchers hardwired inflation persistence into their macro model so that this theoretical model goes well with the observed data. There's also an alternative strand of literature which focuses on learning on part of economic agents, which could be consumers, which could be firms, which could be even policymakers. And from this literature, the focus is on how agents learn about shifts in the monetary policy regime and its associated inflation target, its responses to long-term inflation and other institutional arrangements. And so the viewpoint of this particular strand of literature is that in the presence of poor credibility, agents are forced to compare actual outcomes with those announced by the policymakers. And this learning process on part of economic agents affects the inflation dynamics. In terms of the literature on inflation persistence, the literature has highlighted 4 different types of inflation persistence. So one is intrinsic inflation persistence, which arises from the backward-looking price setting mechanism. Another is extrinsic persistence, which is inherited from the markup over cost as reflected in the marginal cost or the output gap of the economy. Then expectation-based persistence relates to how inflation expectations are formed in the given economy, and what is called a policy-driven inflation persistence, which is due to the actions of monetary policy. Now, to give a context to our paper, we can look forward. We can look at the episode of lower for longer interest rate policy during the last 20 years, in which inflation has remained low and stable. However, with this with the arrival of the coronavirus pandemic, there has been a steady increase in the sovereign debt levels, and there are also concerns regarding a return of high inflation. Of late, some of the major central banks around the world, including the US Fed, the ECB, and the Bank of Canada more recently, have announced changes to their monetary regimes. And this paper, in a way, helps us to look at what is in fact for us. So the contribution of our paper is straightforward. We look at the role of monetary regimes in explaining inflation dynamics over a period of more than a century in the case of UK and USA. This period witnessed 4 distinct monetary regimes, which is the classical gold standard in the early part of our sample. Then the interwar period, which comprises of the 2 world wars. Then the Bretton Woods system, which was in for about 20 to 25 years. And then starting from the breakdown of the Bretton Woods system, we moved to a free float exchange rate system. So through a century-wide time-dependent analysis of the interplay between persistence, policy, and credibility, we aim to contribute to the literature on 2 of the most important economies in our current system. We use long-term time series data to study the evolving causal structure between these key macroeconomic variables, with the hope that this would help policymakers to set the right agenda and framework for monetary policy in the future. So this is a related literature where this is a theoretical literature where some of the papers have highlighted how learning on part of economic agents generate inflation persistence. And consequent on this theoretical literature, there's also wide empirical literature which is available going back to as early as Bas.
Manu, you have 10 minutes left. I think you should skip this literature and go to your.
Sure, ma'am. Okay. So it suffices to say that there is a wide variety of empirical literature focusing on developed economies mainly, which has found two things: that there is time with the inflation persistence in these economies have varied across time, and this corresponds well with shifts in monetary regimes. Now, the question is, what is a monetary policy regime? So a good way to look at it would be to see it as a set of monetary arrangements and institutions accompanied by a set of expectations. These are expectations set by the public with respect to policymakers' actions and expectations by policymakers about the public's reactions to their actions. And then the question is, what is credibility? Credibility in simple terms means a commitment to follow well-articulated, publicly announced, transparent rules and policy goals. This is also, it can also be thought of as the extent to which public believes that a shift in policy has taken place when indeed a shift has occurred. This is referred from Kurien 1986, which is one of the first few works on central bank credibility. There are different ways to measure credibility. For example, Kurien et al. In 92, Campillo and Miron devised a scoring scheme to compute an index of central bank independence and correlate that with policy credibility. One can also look at the dynamics of actual inflation or inflation expectations to measure credibility. And similarly, variation in other economic indicators can also be looked at as a proxy for credibility. So diving into the empirical part of our paper, we utilize the Jorda-Shularik-Taylor macro history database. And what I plot for you is the inflation rate in United Kingdom and United States from 1870 till 2016. These plots show the actual inflation as well as the trend rate of inflation. Moving on to our univariate analysis. So to trace the time varying path of inflation persistence, we lay down a 3-equation state space time series model where inflation is modeled as an autoregressive time process with time varying parameters. Here, the alpha t parameter represents the time varying intercept, whereas the beta t parameter represents the time varying inflation persistence. We use a Kalman filter and maximum likelihood technique to solve this model. Importantly, the beta parameter, which is the inflation persistence parameter, depends on this parameter CT-1, which I'll talk about in the next slide. So in this model, if I go back, pi t is the 5-year centered moving average of actual inflation, and CT is our proxy for regime credibility, which has been which serves as a signal for credibility. We've derived this from Alici et al. 2009. CT variable weighs the relative likelihood of inflation converging to a high rate versus a low rate and is defined as follows. So in a low inflation scenario, inflation converges towards what is called pi low, which we assume to be 5%. In this case, CT converges to 1, which is perfect credibility. In a high inflation scenario, actual inflation inches towards pi high, which we assume to be 25%, which is the upper bound in our data sample. CT in this case converges to 0, signifying a complete lack of credibility. Now, this slide shows the results derived from our univariate model. The top 2 charts correspond to UK and the bottom 2 charts correspond to USA. We can focus on the inflation persistence parameter, basically this and the lower chart on your right. The evidence in this case is clear that inflation in the UK and USA shows large variation across time. there is low and stable inflation during the initial decades, which correspond to the classical gold standard era, as well as during the initial part of the post-World War II phase and after the 1990s. Our estimate for the gamma parameter, which is the parameter for credibility, is positive and significant in both in the case of US and UK. So what this results translates into is that the credibility of the regime can influence inflation dynamics in conjunction with the credibility hypothesis. I'll skip this slide for now. Moving over, the univariate analysis is a very constrained view of the economy. And so to
5 minutes left.
To address some of these questions, we dive into a multivariate analysis where we look at a vector autoregressive model with and introduce time variation in both parameters and model innovations. So this allows us to focus on implied shifts in the conduct of monetary policy, conditional on the other characteristics of the economy. So what these equations signify is a time varying parameter vector autoregressive model with stochastic volatility. The vector of endogenous variable in this case comprises of economic activity, which is growth in real GDP, inflation, which is the change in CPI, and monetary policy being proxied by the short-term nominal interest rate. All these variables are derived from the Jorda-Shularic-Taylor database. So to present the first results from this multivariate analysis, we plot the time varying standard deviation for short-term interest rates for United Kingdom and United States. These model identified monetary policy shock are a reflection of the non-systematic monetary policy actions. In other words, according to Primisseri 2005, these changes or these shifts in the standard deviation of monetary policy shocks signifies a change in the monetary regime, and these changes corresponds to our very well to the way we have defined our monetary regimes, starting with the gold standard, then the interwar period, and then the subsequent Bretton Woods and the free floating exchange rate period. Now, these are the results derived from, this is the inflation persistence derived from the multivariate model, and we can see that this gradually increased and reached a high during the 1970s, both in case of UK and USA. Now, the question is what explains these results, and through a narrative evidence, we would like to say that different regimes across these 150 years had certain characteristics which made them more credible vis-a-vis other regimes. So for example, the classical gold standard period was thought of as a rule, and adherence to such a rule meant that monetary policy was able to avoid the time inconsistency problem. It was also understood that the gold standard rule was a contingent one, and if there were emergencies like a war, and there was a departure from the gold standard, it would be restored. So in our view, the gold standard based monetary regime had a high degree of credibility, and which is why the inflation persistence in this period was low. Similarly, the interwar period had a lot of things going on. There was a buildup of a lot of sovereign debt. There was a change in the political scenario, and there was a repeated departure from gold parity. And so this was not credible, and that's why we see that persistence and also the inflation rate was quite volatile during this period. Similarly, in the Bretton Woods period, the political scenario had changed. There was some bit of restoration of credibility of the international framework, where there was a global order which was put into place. But then very quickly, all this came under a lot of doubts as the US especially started following Keynesian demand policies to maintain full employment at the expense of high inflation. And so the stagflation episode, which was there in the 1970s, destroyed any credibility that was left in the system. Beginning once the Bretton Woods system was broken down, we entered a high inflationary phase. And it was only when in the 1980s, when the monetary authorities adopted tight monetary policy with a firm commitment to control inflation, we could see that the inflation rate was brought down, and inflation and subsequently inflation persistence also came down. Likewise, the Bank of England also adopted a rule-based inflation targeting regime in 1997, and we see that towards the later part of our sample, inflation persistence has remained low and stable. So with this, I come to our conclusion slide. We would like to state that credibility of a monetary regime serves as a key link between the policy framework and inflation persistence observed under a given regime. Credibility in turn is determined by the ability of monetary policy to anchor inflation expectations and pursue the objective of price stability. I've already covered rest of the things in my paper. To end my presentation, it shows that empirical and historical evidence presented in our paper is therefore consistent with the view that inflation dynamics depend upon the reputation and credibility of a monetary regime. So with this, I come to an end of our presentation, and over to the respected audience for comments.
Thank you. You kept time very well. Now there's a question from Gaurav Verma. What is the implication of your model with reference to India at present? In the sense, what do you think is the monetary policy regime credible or not? Let's put it in terms of your.
So in the case of India, where such long-term data is not present, it would be hard to say anything of that sort. But in case of the RBI and also some of the independent researchers have taken a look at how inflation persistence has behaved over the recent years in the Indian context. The conclusion from that, from those different papers and also the research being carried out by the RBI, the conclusion is that inflation persistence has gone down tremendously over the past few years, and especially after the adoption of inflation targeting.
There's a question from Nandan Kishore. Can you see the chat, Kundan Kishore? Can you see the chat bot? Alternative view of chat box. Alternative view of inflation persistence is that it is the persistence of the cyclical component of inflation, as inflation expectation captures the long-term slow-moving inflation. Long-term trend can also be defined as the inflation target for inflation target. In fact, I wanted to add to this that your definition seems a little circular to me. You say that credibility or depends upon inflation, and inflation depends upon credibility, and so on. No? So this is a better, more, better way of breaking it up.
So I agree with Dr. Kishore in his view that the cyclical component of inflation is in fact, there are papers which look at the inflation gap persistence, but in our case, because we are capturing the we are constrained by the data. So because this is annual data, we have only 150 observations, as compared to some of these papers which look at inflation gap persistence. They have quarterly data for about 5 to 6 decades. Also, in our model, we are looking at we are allowing for the time varying intercept in the model, both in case of the univariate analysis as well as the multivariate analysis. So in a way, this captures the shift in the target. So the persistence parameter is not, in that sense, it's not biased by a change in the target. The change in the target is already accounted for in the model.
Well, because you have to be a little careful. Like in your one of your last slides, you said something about inflation expectations, but you're talking about very different regimes, like the gold standard and so on. There was no concept of inflation expectation. Now, Shushanta Malik has a question for you. Credibility could be greater during IT regimes relative to non-IT regimes. And these regimes are very different. The same thing. You could compare persistence between two regimes.
But
you know, there has,
yeah. I mean, we are not explicitly talking about inflation targeting regimes per se, but you know, after inflation targeting, for example, US Fed has recently moved to an average inflation targeting, and there is also the concept of price level inflation targeting. So, because we do not have any historical precedents for these two things, can we say something about how the inflation persistence is likely to behave under these regimes? So, in a way, our analysis, by going back to whatever regimes that we've seen so far and looking at their characteristics in terms of the institutional setup and in terms of how they were defined as a rule, we try to bring some evidence to the table that this is the likely way in which inflation persistence could behave.
Yeah, another point I had was that your definition of persistence, nowhere do you bring in supply shocks, you know? And when you're talking about COVID-19, in this period, we've seen a lot of another cause of persistence or de-anchoring of inflation expectations could be multiple supply shocks. Now, Chetan has a question on this. He said that, is there a way to integrate how central banks historically dealt with demand shocks where there is divine coincidence and supply shocks where there is a trade-off and where arguably more credibility accrues from dealing with the matter? Do you have a historical perspective on this? You know, there is a trade-off. If you have a supply shock, you have to sacrifice output to reduce inflation. So
these are interesting questions to think about, and in a way, I think that our multivariate analysis would enable us to answer such questions. I'll take a note of this, and thank you so much to Dr. Bhate for this question. So I think this remains a work in progress, and I'll look into it.
Yeah, there's a question from Sanjay Singh. Very nice presentation. Could you talk a bit more about your structural interpretation of inflation persistence? Second, are there cost push shocks in your setup to capture volatility in the 70s? This is what I was telling you. If so, it's interesting that your model is putting a weight on monetary credibility. Where are the cost push shocks in your model?
So
you don't see it in your multivariate model either.
It's there in the multivariate model by looking at the response of inflation to inflationary shocks. So that all these cost push, demand pull shocks, all these shocks are in a limited way, I would say, are built into multivariate analysis. But yes, these are not present in the univariate analysis. And that's why we move towards a more flexible form of multivariate analysis, where we not only capture these different types of shocks, and also shocks which are, I mean, we are accounting for all these shocks arising from inflationary shocks or demand shocks or even policy shocks. And we're accounting for all that, we are presenting the evidence.
How many variables did you have in your multivariate? I didn't see, there were 4 or 5 variables, mostly.
There were 3 variables.
Only 3 variables, no? So where are the cost push shocks?
So we account for real GDP as a measure of economic activity. We account for inflation as a measure of inflation and also the short-term interest rate. So,
okay, Professor Kishore has a suggestion for you. Authors can also look at Bordeaux and Hobrick 2004 for an alternate view on historical measure of monetary policy credibility. I think your definition is a little circular. So, either breaking up the time series or, some independent definition would be much better.
Okay. Yeah? So, thanks to Dr. Kishore for another piece of advice. My work is has heavily benefited from Michael Bordeaux's work, and for some reason I missed onto this paper, but I'll definitely have a look at this. Thanks again for the suggestion.
Yeah. Any more questions? There are no more questions. So just one thing I wanted to tell you again: be a little careful in your writing. There are various. Your slide, for example, you talk about UK and US. And you say that these are the world's most crucial monetary systems. I think in India, we should have more pride in our own monetary system. And we account for a very large part of the global population, and what we do, what our monetary system does affects welfare for so many people, right? So,
Sure. Yeah, thank you.
Okay. Well, thank you. So now we go to the third paper. Very good time, I must say. So this is a paper on the long-run effects of monetary policy, with all the authors from University of California at Davis. Sanjay Singh will present his joint paper with Oscar Jorda and Alan Taylor. And the paper itself is more than 70 pages long. So you have 20 minutes in which to present it, Sanjay.
Thank you. Thank you for putting us on the program. As Professor said, this is a joint paper with Professor Oscar Jorda and Alan Taylor at UC Davis. Since Oscar is also at the Fed, the usual Fed disclaimer on this paper applies. So the question in this paper is an old one, which is, do monetary interventions have any effect on macroeconomic outcomes in the medium to long run horizons, where medium to long run that we consider is going to be 10 to 12 years out? To answer this question, we use a long panel data. So similar to what Bhanu was using, we use data from 1890 to 2015, 125 years for 17 now advanced economies. I'll tell you what these economies are. The data is on output, and then in the spirit of a solo decomposition, we will look at data on capital, labor, and then a solo residual by putting some structure on the aggregate production function that we will call TFP. We identify monetary shocks using an instrumental variable technique that builds on the trilemma of international macroeconomics. I'll explain in more detail what the trilemma entails, but very briefly, if a country has fixed its exchange rate with respect to another currency and is open to capital flows, then you lose monetary independence, and the interest rate movements across two countries are going to be positively correlated. That positive correlation is what we're going to exploit here to identify monetary shocks to the home economy coming from base country interest rate variations. To estimate impulse responses or to these shocks on macroeconomic variables, we will do that using a local projections instrumental variable technique. In the paper, we do a lot of robustness. I will not have time to talk about this, but we throw robustness like exclusion restriction evaluation. Think of structural breaks in the long panel that we're looking at, control for business cycles, and so forth. I'd be happy to talk more about that in the Q&A. The key takeaways of our paper are that we find large persistent effects of these monetary shocks. So in response to, for example, 100 basis points reduction in monetary increase in monetary interest rate in the home economy, we find that output is lower by about 4 percentage points relative to the pre-shock trend a decade later. Now, where do these persistent effects come from? We find, like this is the solo decomposition, we find that in response to these monetary shocks, capital is persistently lower, labor falls, but it returns back to the pre-trend level a decade later. And we find then the residual, the solo residual TFP is also persistently lower. So these are sort of the new effects in the sense that if you want to think of hysteresis, it doesn't seem to propagate, at least through monetary shocks. Hysteresis implied by monetary shocks. It seems to propagate through capital and TFP and not so much through labor. We'll reconcile these facts in a DSG model. The exercise I'm going to very preliminary touch on today. But overall, the paper is providing evidence against long-run money neutrality hypothesis. The data, very similar to what Bhanu was using, we leverage this macro history database. where we take the data for interest rates, output, prices, investment, house prices, stock prices, consumption, etc., for these 17 now advanced economies. This is annual data set from 1890 to 2015. We combine that with long-term productivity database collected by Bank of France economists, Antonin Bourgeois, Tsete, and Lecat, from whom we get data on hours worked and number of employees. So we take a product of these two variables to construct our labor measure. And then we get data on capital stock from them, which is constructed using perpetual inventory method of investment on machines and investment in buildings. And then we take these and then construct a solo residual by imposing a Cobb-Douglas aggregate production function on labor and capital with some capital share. We played around with various robustnesses on construction of perpetual capital stock using perpetual inventory method. And we also played around with doing robustness with different measures of capital shares across the sample. Our results are robust to a variety of robustness checks that we've done on data construction here. So, but I'm happy to talk more about that later. So now the second ingredient is identifying monetary shocks. We identify monetary shocks using the theory of trilemma, which is basically if you are pegging your currency to another country and you're open to capital mobility, then interest rate movements across two countries are going to be positively correlated. The instrument construction is done in detail in this Journal of Monetary Economics paper by Jorda, Schulrich, and Taylor. But let me, to fix ideas, describe in somewhat detail how we proceed. So we divide the population of countries into three subpopulations. There are going to be base countries. I'll tell you who the base countries are in the historical sample in maybe 2 slides. Then there are countries which are pegging to the base country currency. And then there are float countries who are floating with respect to base countries. Now, to think of capital mobility, we use this continuous indicator, continuous variable from Quinn, Schindler, and Toyoda, which is a capital mobility indicator, where 1 indicates openness, 0 is closed. To classify a country as peg, we classify a country as peg if it's not only pegged its currency this year, but also previous year, so T-1. This is to avoid some selection or be conservative into thinking of selection into and out of pegs. So we make them to be, we only select countries that remain pegged at least for 2 consecutive years when we identify monetary shocks. And our definition of peg follows the Opsfeld-Schamburg Taylor definition of peg, which is the countries are in a 2% target band, target currency pegs around a target zone in a la Krugman and Swenson. Then our instrument Z for a country J at time T is going to be constructed as follows. We take interest rate changes, this is the annual year-on-year interest rate changes for the base country, and we take a residual by projecting these interest rate changes on base country macroeconomic controls. So we're basically running a Taylor rule regression for base countries using base country macro financial variables. This is to just make sure that base country interest rate movements are not predictable to the home country. So we clean out those interest rate movements in the base country by projecting them on their observables in the base country. And then we adjust them for capital mobility. Our policy variable of interest is the interest rate on nominal interest rate on the short-term 3-month government bill, and Z is going to be the instrument variable. So let me show you the first stage of our analysis. In the first stage, we regress home country interest rate changes. These are annual year-on-year changes in the home country on the country, we allow for country fixed effects here and on the instrument that we constructed. And we add in a vector of home economy macro financial controls. In 3 slides, I'll tell you what goes into the vector X, but this is sort of going to be a kitchen sink. We're going to throw in as many observables as we have here. So in the first stage, I want to show you what the first stage coefficient B is. So what this table shows you is for the sample of pegs, all years is 1890 to 2015, post-World War II is 1948 to 2015. For the sample of peg countries, we find that the pass-through of this foreign interest rate change on home economy is about 60%. This is consistent with the simulations reported in Obstfeld-Schamburg-Taylor, where countries are floating within a 2%, they're in a crawling peg of 2% peg target zone band, a la Krugman-Swenson, and you would get numbers like 60% from that. Second, the thing to note here is that we don't have a weak instruments problems. Instruments are weak, the t-statistics are pretty large. Instruments are not weak, t-statistics are pretty large, and they are relevant. Just to fix some more ideas on what our sample entails. So the average peg duration in our sample is 21 years. Think of these are large regimes, as Bhanu was talking about. The gold standard, there's Bretton Woods. It's not the Obstfeld-Rogoff, or the ideas that the countries quickly move in and out of pegs. So this is a sort of a more of a stable. We have stable episodes in this sample. And second, you may be worried that pegs are somewhat special compared to floats. On at least some of the parameters that we can observe, we find pegs are, if at all, more open to capital mobility than floats. So this is capital mobility index, average capital mobility index, where k equal to 1 means fully open, 0 means closed, and you see they're broadly similar across pegs and floats. So what we do then is we're going to then take these interest rate shocks that we get from the first stage regression that I showed you, and use these interest rate shocks to the home economy to estimate impulse response of a variable y, think of output, for a country J at horizon H relative to horizon -1 by running this local projection regression. So where we allow for horizon-specific country fixed effects, control for a vector of home economy macro financial controls, which I'll tell you in the next slide. And the beta H will directly plot the cumulative impulse response of a variable y at horizon H relative to horizon -1. A caveat of our analysis is that what we're going to show you are results which people call our local average treatment effects. So they're going to be monetary shocks results applied to countries that are pegs. Now, if you want to extrapolate that to a sample of all countries, you'll have to make assumptions that pegs and floats are similar, and the monetary shocks lessons that you're going to learn from this apply more broadly to floats. But our caveat here is that this analysis is strictly for countries that are pegs. Now, what else goes on that vector X that I've talked about for a while? So it's a kitchen sink. We add control to annual lags of GDP, consumption, investment, CPI, short-term rates, long-term rates, stock prices, house prices, credit variables, to think of global business cycles. So you may be concerned that, when the monetary shock is hitting the home economy, which is because the base country is changing interest rates, that could be there is some global business cycle shock. And so we control for global GDP and base country GDP to soak up some common business cycle variations that may be on across countries. So the sample is 1890 to 2015, 17 now advanced economies. It's an annual sample, and I'm going to show you the results in the next slide. So this is the main result. On the left is the full sample from 1890 to 2015, and on the right is the post-World War II sample from 1948 to 2015. The x-axis has horizon in number of years since the shock happened, and the solid blue line here is the local projections instrumental variable impulse response that we estimated for GDP at each horizon. The dashed red line is the OLS estimate. Think of this as a Cholesky identification because we also control for current values of other variables in this estimation. And the shaded bands here are confidence, but 1 and 2 standard error cluster robust confidence bands. So in response to a contractionary monetary shock, which is normalized such that the home interest rate goes up by 100 basis points on impact, what we find is that the GDP falls and is persistently lower by about 3 to 5 percentage points, depending on the sample that you look at. Now, compare that to ordinary least squares estimation, you see that the instrumental variable is doing something. It's identifying some variation that's not being picked up by the OLS. So 12 years out, GDP is lower by about 3 to 5 percentage points, and these results are pretty significant and show you evidence against money neutrality in the 12-year horizon that we will to identify here. Now, we do a lot of robustness. I don't have time to talk about that. I only have 5-6 more minutes, but I can talk about robustness later on. You may be worried about exclusion restriction violation through various channels. In the paper, we do spillover corrections implied by a small open economy model. We allow for structural breaks in growth rates of TFP, GDP, GDP per capita, control for those structural breaks in our estimation. We control for, as I said, base GDP, global GDP. We control for current account, exchange rate with respect to float, some open economy variables, because you may be worried that it's not strictly the interest rate channel, but some other trade balancing channels that are leading to these results. So we're not strictly identifying responses to monetary shocks, but to a mixed set of other channels that are mixed with that. We also do robustness where we have
You're doing well.
5 lakhs of control variables and control variables in level. So the results overall are pretty robust to variety of checks that we've done, but we are open to talk more about listening more about these. What else we can do? So second part I want to very quickly talk about is now where do these persistent effects show up? So on the first chart here is real GDP, which I showed you earlier for the full sample from 1890 to 2015. The remaining 3 panels are for labor, capital, and the solo residual that we call TFP. So what you see is in response to this contractionary shock, labor falls, but it returns back to the pre-shock trend eventually. Capital, on the other hand, is persistently lower, and it falls by about 4 or 5 percentage points in the 12-year horizon. Since capital does not fall more than GDP and capital share is less than 1, and labor goes back, so mechanically we expect TFP to pick up the remaining, the difference between GDP and capital at the 12-year horizon will be picked up by TFP, and that's basically what you see here. So TFP picks up the remaining difference. That as the residual picks up the remaining difference. So that's sort of, if you want to think of what are the prominent channels through which these persistent effects propagate. It doesn't seem like labor hysteresis is the relevant channel to think of. Rather, TFP and capital are seen to be more important channels here. So consistent with that evidence that it's labor, it's TFP and capital, we then augment off-the-shelf medium-scale New Keynesian DSG model. We add hysteresis effects a la this AER paper from 1990 by George Stadler, where you allow TFP growth to depend on output gap. So this is TFP growth rate, GT, Z is level of TFP. TFP growth rate, which is usually an exogenous process, mu, some AR1 process or whatever process you have in mind in these models, we allow that to, in a reduced form, depend on output gap. So YT output relative to some flexible benchmark of output. You can get this dependence coming out of a lot of endogenous TFP growth models. Here, we are not going to take a stand on what exactly the model is, because in the historical sample, we don't have variation to think about. Is it the R&D? Is it learning by doing? Is it like, what are the mechanisms through which this hysteresis is operating? We don't really have a way to go deeper into that. So all we want to do is, we want to inform what is this eta, the hysteresis elasticity that our models will need to match if they want to replicate this empirical pattern that we find in the data. And to see that, to know what eta would be, it's basically, we estimated impulse response of TFP, we estimated impulse response of output. It's basically a ratio of those two variables, in effect, is going to give you the estimate of eta. And that's what we do through some bit more formal methods here. We estimate using a 2-step minimum distance estimation, this eta for these two samples. And since the eta estimate is pretty large, but it's consistent with an estimate that DeLong and Summers in their Brookings paper came up with for the US economy. So summary and in conclusion, this paper finds evidence against long-run money neutrality. A monetary shock causes output decline over a long period of time, causes a decline in TFP capital stock, not so much on labor. In the paper, we provide formalized identification using a small open economy New Keynesian model, do various robustness exercises, and thank you for your attention. It's late, and I'm happy to receive your thoughts on this.
Good, very good, good time. So now, while we're waiting for some questions, I could. So you know what you're learning from you is that we should not monetary policy should never tighten, and it's useless to to be stimulative. So should just stay put, do nothing, is it? So yeah.
That's a very good point. So something that I haven't been able to show today is we have some results, if I can find them, on asymmetric shocks. So what happens with tightening versus contractionary shocks versus expansionary shocks. When monetary policy eases, does it expand capacity versus when it contracts? What we find in the historical sample when we condition or do the sign-dependent impulse responses is contractionary shocks seem to be what are driving these effects. So it's sort of monetary policy can kill the productive capacity of the economy, but it can't restore it. So expansionary shocks don't seem to have this persistent effect on GDP. So it gives you then this, I think there are many ways how you want to interpret this. One is, does running the economy hot later on help? This analysis suggests you can't really bring back the productive capacity, but does premature tightening, if you cause a recession,
but
you can't reverse that.
I had a question about this because this hysteresis effect, in open economy model, that Obstfeld, Rogoff, basic models tell us that normally for symmetry, you shut down the current account or debt accumulation and so on. Once you allow that, you allow wealth effects, then there is hysteresis from monetary shocks in the theoretical model.
Right.
So I don't know if your model, you have a current account that is more for trade effects. I don't know if it controls for wealth effects or it captures those. Because that might be another source of hysteresis.
No, I completely agree. So in these like small open economy models, you can get non-stationarity through those. So we play with the Schmidt-Grohe-Uribe closing small open economy tricks, where we allow a little debt elastic interest rate premium such that economy returns back to the steady state. So we don't get the hysteresis coming from those channels. And what would in our exercises, so this is something we're going to update the paper with more results, especially on these wealth effects. I noted what we find is that if the debt to GDP ratio of a country, external debt to GDP ratio of a country is less than 100%, which is true for our sample of countries, then the debt revaluation effects actually go in a way that, so after a contractionary shock, you would expect output to go up eventually, because country will try to save, and that saving is going to basically mean, because today they're going to reduce consumption, save in response to foreign interest rate shock, and tomorrow onwards they're going to undo that saving by increasing their consumption. So tomorrow onwards, actually output would go up in those models. So you don't expect, you actually expect impulse responses to fall and then go up and then come down from the other direction. So that's sort of what is what would not be consistent with these stories, if at all. If you want to introduce those effects here more strongly, yeah.
Anyway, there's a question. Kundan is telling you very nice paper. The 4 in your model is based on trilemma hypothesis. How do you take into account Ray's dilemma approach, as the nature of the economy is very different today than it was a century ago? Right? You mostly have floats, very few pegs. Anyway, you
right.
have historical data. Then Sushant has a question on why there is no monetary non-neutrality following a contractionary shock, although it's present for a contractionary shock. Chetan,
right.
Is the story that interest shocks lower investment, which lowers the capital stock, and TFP's capital augmenting, which pushes TFP down historically?
Right. So starting with Chetan's question, exactly, he's right. So it's basically You could write down a model where TFP is capital augmenting, and there's a co-integration between TFP and capital in these models, endogenous growth models, a la Agnew and Howitt, and you would get that through that channel. We're just going back in reverse from Sushant's question. Yes. So why this is a good question. Why expansionary shocks don't have these persistent effects? We take a very lazy tack in this paper. We say, well, Schmidt-Grohe-Uribe emphasized downward nominal wage rigidity as one of the reasons why you can get these state dependence or asymmetric effects. Basically, wages cannot fall, but they can go up. So, in response to expansionary shocks, prices have to go up, wages can adjust upwards, but really contractionary shocks is where wages need to fall and they cannot, and that generates a Keynesian recession. So that's, again, we don't have much more detailed data to think more deeply about what is precisely generating this sign asymmetry, but I think that's an interesting question. So here we are just saying, there's a literature which says these things can happen. We can tell you one of the reasons could be those papers. Kundan's question, I think you're right. I mean, so the dilemma approach is sort of saying, well, your float or peg doesn't matter. You're going to be affected by US interest rate shocks because you have dollar exposure or you have dollar denominated trade, whatever channels there are, right? So the float countries are going to be affected. So what we are doing here is only for the peg countries. So they are affected. Now, if you want to look at float countries, we do some analysis where we find floats are also, they also get this pass through of US interest rates into the home economy. And that's consistent with the Ray's approach. And I mean, there's this more broadly thinking about, there's this Ilzevsky, Reinhard, Rogoff paper in QJE, which documents that the world, if at all, has become more and more close to peg through various channels like, I don't know, dollar trade or dollar credit or various channels. And so there's a huge dollar exposure, which effectively is exposing the entire world to dollar interest rate changes in the US economy, which are effectively like a peg economy in a more and more way.
Professor Chitre has a question. Your result that the long-term effect of monetary policy takes place through capital and productivity makes a lot of sense, but would that not make the long-term trend? How do you take that into account when you talk about the ratio of output to I don't know.
I'm not sure I understand that. So what we are showing you is not.
When you talk about the trend of the ratio of output to trend out.
So this is not detrended. So we're not detrending our output series here. This is just the raw series of output. So in the VAR, sometimes we detrend output. So we are not doing that. Maybe that's a part of the confusion here.
You have a long-term focus in your study, right?
Right.
Kundan has another question. Also, how do you take into account the serial correlation in the local projection estimation, as it does not seem to control for the lag of the left-hand side variable?
No, so we do control for lags of left-hand side variables. So this is like GDP is the left-hand side variable, and we add 2 annual lags of these variables. So think of exactly the serial correlation or estimation issues that some people have noted happen in these estimations. So I think the common result out there is that if you add 1 annual lag, that should be enough to absorb these. We have added 2 lags here. We also played around with 5 lags. The results don't seem to depend on that.
Well, you seem to be supporting Stiglitz. You know, there's a famous quote of his that monetary policy, you can pull on a string, you can't push on it.
Exactly. So this is the pushing on a string narrative comes from the expansionary versus contractionary, and then the other is, I think someone told me the other day.
I have another source of hysteresis, which I don't know if you've tested here. Anyway, your sample is only advanced economies, but you know, in emerging markets where you have a dual structure, then money supply or liquidity really matters in the sense just payments and it's not just through interest rates that you get the impact of monetary policy. It's also so that can be quite important, and I think it would work symmetrically. No? If, like in
Right.
India, we saw that payments just froze when the liquidity was too tight in 2018-9. Yeah. So,
I agree. I agree. I mean, so there are other channels, which is why I think we wanted to focus only on the now advanced economies, because we don't, we can more confidently say the these are exclusion restriction violations, right? What is the channel, or what is the, or you can, in other words, if you want to be more generous, you can be say, because this is a transmission mechanism on how interest rates propagate to the economy. So I think that's right.
Professor Chitre has clarified his question. I meant that it should not influence the trend and hence the output gap, which involves the ratio of output to trend. That your estimation, what is it? Anyway, I think we're out of time, so maybe you can take this up with Professor Chitre on a one-to-one basis.
Thank you.
Excellent paper, very good, interesting discussion, good answers. And I must say, it's wonderful having this online thing. We're able to get Sushant and Kundan and Chetan. Wonderful to have all of you with us. And, this is an ideal kind of set of people to discuss monetary policy issues. Yeah?
Thank you. Thanks a lot.
Good night.
Thank you. Thank you so much, Professor Goel, for chairing the session. And thank you to all the presenters. We have had an excellent lineup of papers today. And also thank you to our keynote speaker once again, Professor Ugo Panizza. We thoroughly enjoyed that session. So with that, I would like to close today's session. But of course, we have one more day left before we call the conference to a close. A much awaited day, of course, where we start tomorrow at around 4:30 p.m. with a session on central banking. And then we have another excellent keynote speech lined up by Professor Arvind Subramaniam. And lastly, before the end of the conference, we have the highlight of the conference, a special session in honor of Dr. Subir Gokan, an ex-deputy governor of the RBI and also an ex-faculty member at IGIDEA, which will be presided over by our director, Professor Mahendra Dev. And the chief guest of the session will be Dr. Duvari Subbarao, an ex-governor of the RBI. So I would all love to see all of you back again tomorrow for the session. And of course, we are going to be announcing the 3 best paper awards in the closing session tomorrow. So it's in the special interest of the presenters to be particularly present there. So please, all of you join us again tomorrow. Thank you so much.
What about the photograph? Everybody put on your videos.
Oh, yes. Thank you so much. Thank you so much. So please, everybody can switch on the video so that this is the best we can do in a virtual setup. We'll just like to take a snapshot of this moment. Thank you. And I'll let you know once it's done. Thank you.
And thank you, Rajeshwari. Excellent comparing, keeping stringing together.
Thank you. And thank you for keeping
people have been working very hard. Got so many emails from you.
And we have realized that organizing a virtual conference is significantly more hard work than organizing a conference in person.
But it's interesting in different ways.
Yes. But yeah, as you said, we would love to see all of you, Kundan, Sushanta, Chetan, Sanjay, all of you.
Professor Chitre, so nice to have you here. Yeah, but Professor Chitre can come over from Pune, but we have people from UK and US.
Hopefully next time we'll do a conference in person and we can have all of you on campus.
Okay, bye. Bye. Good night.
1 second, let me just ask, is the photograph done? Okay, it's done. Thank you. Good night to everybody in India and good morning or good afternoon to everybody outside. Thank you so much.